We started the week looking out to next week in the Federal Reserve, and I think most people we spoke to, when we asked them about the summary of economic projections, are they going to change from December? The answer was no. Got a little bit more information now. Is there a chance they change next week from December?
Well, there's a chance that we heard some of them talking in between the meetings about the possibility that they might not cut rates this year. Raphael Bostic, for example, Neil Kashkari talked about that. So it is possible they could move their dots. We're assuming their dots were in the 2 cut range before. So if they look at this data and think this is going to persist, and you're going to have to take it apart to really know whether it is going to persist. The portfolio management thing that we care about for the PCE looks like it was up just 0.2% after 5.9% in January. So it wasn't the stock market's fault this time. Insurance, health and medical insurance, though, up 1.4% after falling 1.1%. Now, this is probably a catch-up to the turn of the year and when insurance companies raise their rates. So we're probably seeing a little bit there. But those 2 areas are things that are going to be something the Fed is watching.
To put a bow on all of this, what we're seeing in initial jobless claims and continuing claims, people can get a job and they're not getting laid off in a way where they've got to file for claims, right? It doesn't seem like that's a real issue. On the PPI side, can we see that the narrative there is we are now seeing goods reinflation in a way that a lot of people didn't want to see?
That's a good way to put it. You didn't say in a way that people didn't expect. It's been expected that we would see goods deflation sort of slow and end because trees don't grow to the sky or fall into the ground the same way. So at this point, it looks like maybe that's where we are. Now, in terms of jobs, what you would expect from jobs is that people spend money because they have employment. And really, it doesn't look all that bad here. While we saw just a 0.6 rise in retail sales overall, a lot of that was held down by gasoline stations. Gasoline prices were up only 0.9%. That wasn't what people had expected. Clothing store sales fell by 0.5%. Department store sales fell by 0.2%. But motor vehicles were up 1.6%. Electronics and appliance stores up 1.5%. So some categories did fine, some categories not so good. The food services and drinking places we always look at, they were up just 0.4%. So it does show that people are still going out. It's the only services number in the retail sales.
That's the TK indicator.
That's the TK indicator,
that's why,
yes.
Just traditionally on this program, we've always looked at that. That's retail sales. I want to talk about jobless claims briefly. If you are just joining us, big downside surprise, 209, and the previous week revised to 210, so way better than expected there across the board. The estimate was 218. We're actually looking for that to climb higher. Didn't happen. 209 on jobless claims this morning, and PPI hotter than expected. And Lisa writes to point out, yes, there is lots of conflicting data at the moment, and this morning there's something for everyone, but ultimately the trend this week when it comes to the read on inflation, upside surprise, upside surprise. And what you've seen in the bond market off the back of that, 4 days of yields climbing on a 2-year. Check out bonds right now. We can look at the 2-year together. Starting life this week in the 440s, now at about 464. Yields up by, let's call it 0.5 basis point, up by 2 basis points on a 10-year, 420.75. In foreign exchange, the euro a little weaker, dollar stronger, 109.37. In equities, the S&P 500, positive by about 0.2%. Lisa, I have to say, had the initial move, and rather like what we saw on CPI, the initial move faded after a few minutes or so. I often say when the data comes out, let's see if it sticks. Let's see if it sticks. And a lot of the bad stuff just hasn't stuck at all.
Well, what is the bad stuff here? Is it the higher inflation, or is it the retail sales that people are hooking into and saying, actually, maybe there is weakness here? As you said, people see the narrative they want to believe. And the problem is that we haven't gotten truly conclusive data to really confirm a lasting trend with any of it. I will say, though, it's hard to ignore the upside surprises to inflation.
Jay Bryson, Chief Economist at Wells Fargo, joins us now for more. Hey, Jay, let's get into that. CPI upside surprise. PPI upside surprise. Going into next week, Jay, what kind of changes, if any, would you expect from the outlook from this Federal Reserve?
So John, in terms of the macroeconomic projections of the Fed, I'm not expecting a lot in the summary of economic projections there. You were noting earlier in terms of the dots. I mean, it would only take 2 members to switch from 3 rate cuts to 2. So the median could potentially change next week. And I guess, if there's an upside risk here to the projections for next week, it would be to a little bit higher inflation and, maybe the median dots shifting up as well. But, in general, I wouldn't expect huge changes from the statement next week or from what Chair Powell says in his press conference relative to what they've been saying recently.
Have you changed your view, though, Jay, about the idea of how sticky inflation is and how long it's going to remain high in the face of a labor market that really doesn't show signs of cracking?
So to answer your first question there, Lisa, yeah, we have pushed back we initially thought the first rate cut would come in May. I mean, I think that's kind of off the table, more or less, at this point. We've pushed that back to June. And, I guess what I would say is I think the risk to our forecast would be skewed towards later. That is, I would say the probability of July is higher than May at this point. But in general, we really haven't really changed our views all that much. And in terms of the labor market, I mean, so we saw these initial jobless claims today. Now, I wouldn't make a lot of just 1 week sort of data. If you step back and you take a look at it, what we are seeing in terms of the labor market is the quits rate has coming down really quickly. The job openings is also coming down as well. And then if you look at the unemployment rate, that is starting to move higher here. And obviously it's at a very, very low level still. So what we are seeing is we're seeing some softening in the labor market. It's not like it's falling apart or anything, but that should, as we go forward, continue to bring the employment cost index lower.
How long are we going to remain in this limbo? We're trying to understand what the trend is, and you've got people who are saying the sky is falling, inflation's reaccelerating, take a look at 3-month and 6-month trailing averages, and other people say, cut it out, it's on a downward trend, you're being overdramatic. How long before we have a conclusive decision on those 2 narratives?
At least I wish I could answer that question. I just think we're going to be in this choppiness though for a while here, and so I think we're just going to have to live with that. And I think what you need to do is we need to step back and we need to say, okay, we all look at this data today, and what does this mean for the Fed next week? What does this mean for the Fed in May? The Fed doesn't at this point. It doesn't really know either. It's taking these data in its entirety as they come in, and it'll make its decisions as we go forward. And unfortunately, I think we're going to be in this choppiness, for a while.
So right now, as we take a look at the way that the market's responding, we see stocks really shrugging off pretty much everything. We see bonds reacting, but in a controlled sense. What is the threshold for financial conditions and the easing of financial conditions to create a problem for the Federal Reserve?
So, if we continue to trend in this direction, stock prices going higher, if we continue to see bond spreads coming in financial conditions, and that juices the economy even more, I mean, that would be, I guess, somewhat of a problem for the Fed in terms of its easing path going forward. Now, they're not targeting stock prices, they're not targeting bond spreads. I mean, what they are looking at is the effects of these financial conditions on the overall market or the overall economy in general. People make a big deal out of stock prices. It does have a wealth effect on people, but those wealth effects tend to be pretty small. So the point here is you need to have a lot of financial conditions loosening here for it to really start to have an effect on the Fed's decisions going forward, and I don't think we're quite at that point just yet.
When it comes to Jay Powell, he continuously says at some point this year we'll be cutting. Does that change to later this year? Does this timeline just get pushed back?
I think it does, Lisa. Because what we're seeing is, yes, the inflation rate is trending lower. Now, it's not coming down as much as I guess people would like it to be. But what's happening is that inflation rate continues to come down, and the Fed remaining on hold, the real Fed funds rate is passively going higher, and that's acting then as a passive tightening on the overall economy. And so, in some sense, they need to be cutting rates. Maybe not in May, maybe not in June or July, but they probably need to be cutting rates later this year, or you're going to have a passive tightening of monetary policy, which then could potentially slow things a lot more than people are expecting right now.
Hey, Jay, I appreciate your views, your opinion, your reaction to this morning. Thank you, sir. Jay Bryson there of Wells Fargo. I get it. It's part of the job. If you're in that seat, you've got to make a call on where the Fed's going to come. Totally understand. June just feels meaningless to me. It feels really stale. The answer over the last few months has just been, the correct answer has just been later. later, much later than you thought. It was March, it was then May, it was then June, and based on the data we've had so far, if you're looking to gain confidence from every single data point going into a Fed decision, how can you argue they've gained any based on what we've seen over the last 2 months? In fact, I would argue they've lost some, or at least they should have, based on the threshold they set for us at the start of the year.
I would agree. I am getting some messages from people saying, actually, the retail sales show real weakness. The issue is it hasn't been conclusive, the confidence issue. If they really are looking for confidence, no one who we talk to feels particularly confident about anything right now. There isn't a consensus. We're in this morass of confusion as we emerge from the post-pandemic reality into something else. We don't know what the something else is, and neither do they. And we take a look at this. How can you say with definitive kind of assurance we're on the right path?
Retail sales screams weakness, jobless claims scream strength, and PPI just says sticky, upside surprise all week. I want to get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Hackers. Hey, Yahira.
Hi, John. SpaceX is set to take another step forward in its Starship program. The launch window for the third major test flight opened at 8 a.m. The target for liftoff is currently aiming for 9:25 Eastern. Starship is the largest and most powerful rocket ever developed and has an ultimate goal of taking humans to Mars. The last two tests ended in explosions, with this launch hoping to approach orbit. Treasury Secretary Janet Yellen says it's, quote, unlikely that market interest rates will return to pre-pandemic levels. The COVID pandemic triggered a wave of inflation and higher yields. 10-year yields averaged 2.39% in the decade through 2019. Last October, it spiked above 5% after the Fed raised rates aggressively to combat inflation. Rents in Manhattan rose during a busy February for leasing, with median rent coming in at just over $4,200. That's up 3.3% from a year ago. Overall, the number of new leases signed in February in Manhattan were up nearly 8% from last year. Rents typically drop during the winter months, but apartment prices are not letting up. That's your Bloomberg Brief. John?
Yahira, thank you. Up next on this program, Tesla, the growth company with no growth. A fantastic note in the last 24 hours from Colin Langan, the Wells Fargo analyst, joins this program next as this stock tries to bounce from yesterday's losses.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Stocks on the S&P 500 still doing okay, up 0.25% off the back of another upside surprise on inflation in this country. It was CPI earlier this week, PPI a little bit earlier this morning, up another 2 basis points on a 10-year, 420.95. Under surveillance this morning, the growth company with no growth.
There's a lot to look forward to in 2024. Tesla is currently between two major growth waves. We're focused on making sure that our next growth wave, driven by next-gen vehicle, energy storage, full self-driving and other projects, is executed as well as possible.
Here's the latest. Tesla under pressure as a growing number of firms sound the alarm on demand. Wells Fargo analyst Colin Langan cutting the stock to underweight with a 125 price target, writing this: "We expect volumes to be flat in 24, down in 25. In the wake of price cuts, are lower lease residuals, disgruntled customers, and the possible loss of the luxury brand premium." Colin joins us now for more. Colin, your title, a growth company with no growth. Easy question. How do you value a growth company with no growth?
I mean, we usually use a DCF. You know, you have to look at the long term, right? So, and then you look at the earnings in the out years as well. So we look at a traditional DCF valuation, looking at the long-term growth prospects, and then we also try to normalize it, what you're pricing in. And even on our price target, I still think you're pricing in 10 million vehicles in 10 years. Long way out, but it's still quite a big number from where we are today.
You've got no growth this year, negative volume growth next year, growth the year after?
I have about 10%, a little over 10% growth in the year after. That is supposed to be when Model 2 hits. And to be honest, there's probably risk to that because we'll see how, we'll see what the potential Model 2 is. They're using what's called unboxed production, which has actually never been done before. So there's high execution risk to bring that to market.
Is this a Tesla problem or is this an electric vehicle market problem that Tesla's catching up to?
I mean, what I'm talking about is really more of a Tesla problem, to be honest. I mean, I'm pretty cautious on the auto industry in general right now. I have sales on all the Detroit 3 that I cover. But I think you're talking about a product that's a bit old. We're seeing customers are just not interested in it. And what we found in our report, and one of our real top concerns why we drove the downgrade, is that the impact of the price cuts is having a smaller impact on volume. If you go first half to second half, volume went up just 3%, cut price 5%. And the pricing cuts are painful. It costs almost $7,000 in gross profit per unit lost since they started these cuts. And then, as you mentioned in the intro, you have risk to the brand. You have risk to residual values too, and that's going to cause those disgruntled customers when you come back and your vehicle's worth less. So there's been a lot of pain to do these price cuts, a lot of profit losses, and we're not actually seeing the volume. And that's why I feel like they're going to have to make a trade-off at some point and just sort of capitulate that they can't really grow deliveries with price cuts.
So are you saying that sort of the discussion point around the fact that China is really driving the weakness in Tesla might be overstated, that there might be more at play even domestically for the company in your view?
Well, we're seeing weakness around the world, to be honest. I mean, U.S. actually, if you look at industry data, and Tesla doesn't give regional specifically, but since Q2, it's sort of peaked and softened. So, and that's with all these price cuts, right? So, we've seen weakness in the U.S. I mean, the product is, is it 7 years old now for the Model 3, so it's not fresh and new. We're definitely seeing in China, they're actually flat, but they're flat in a market, at least since Q2 talking about, flat in a market that has been growing, so they're actually losing market share there. And I do think longer term, the threat from China EV companies is very, very real. We did 6 teardowns over the last 2 years. The BYD teardown was pretty phenomenal in how it was engineered. I think they're a real formidable threat when you look on the global stage.
If you're not seeing the volumes with the price cuts, do you think the price cuts were a mistake?
Hindsight's 20/20. I kind of do. I think if you're covering the auto industry for almost 20 years. There's not many places you make money. You make money in luxury and full-size pickups. That's probably half of the global profit pool today. Honestly, historically, it's probably almost all the global profit pool. Right now, we have record pricing that's probably not sustainable. So one of my concerns is also, as we wait for these 2 years, you get Model 2, what I think we're forgetting is that the prior launches were into the luxury market, where there is more room to make margin. Now we're launching into a compact SUV. Compact vehicles are notoriously limited profit. A lot of people even think of them as starter vehicles just to get people into your brand. So very narrow margin starting point, add an e-powertrain on top of that, so you're probably starting in the red. So when they're revolutionizing with unboxed production, they actually need that savings to kind of get there. And the other risk with unboxed is the savings really will only be there if you sell in volume, because the savings are supposed to be, I could get more out of my plant. So if the vehicle isn't very successful in terms of volumes, then you're actually not getting any of the cost savings and the leverage that you get on labor and depreciation.
You don't like the others either. You've mentioned that, the Detroit 3. I want to talk about that briefly. Adam Jonas over at Morgan Stanley, a bit more constructive on this, said this yesterday: lower spending levels, increased cash returns, higher for longer internal combustion engine, uncrowded position. We believe the narrative is changing on global autos. Why do you see it differently?
I think what people are missing, and probably he's missing, is is EVs, right? So even though EVs are softening, we're seeing consumers not interested in them, they still need to sell these vehicles, right? And so, because there's regulatory targets, and even if, let's say, a Republican or Trump wins, it's going to take him time to change the current rules, and the rules are extremely aggressive. So we're probably at least stuck through 2026 targets, which for the Detroit 3, you need about 10%. You're at 3% on average today. So they're going to have to sell more of those. And on top of it, I think people are getting a little numb to the fact that pricing has been very strong. I think pricing could come down. That's kind of well known, and I think that's going to be a pain as you go through the year.
So GM just can't flick the switch and lean into hybrids and become Toyota overnight? Is that basically what you're saying? Is that too difficult?
I think it's extremely difficult, and that's one of the concerns I have for GM is that the bet of going all in on EVs. I think they've already said they're going to do a PHEV, so I think it's going to take them time to bring that to market, whereas, Ford and Stellantis have actually, developed hybrids, and so they could ramp those strategies now.
Colin, this was great. Fantastic to catch up. Really interesting note. Appreciate it. Colin Langan there of Wells Fargo. The growth company, Bremo, with no growth and maybe no growth for the next couple of years.
Which is the reason why you got booted out of the Magnificent Seven.
Yeah.
And that's basically what we've seen so far this year. I do want to just note quickly, I was going through some of the retail sales data, and this actually is a component of it, auto sales and some of the issues there. There is just a more discerning demand, and I wonder how much that's part of it. People are being much more careful with how they buy and what they buy and how much they spend.
You can see where the growth is. This is not my opinion on a manufacturer, the trend, the ultimate destination. It's just where we are right now. The sweet spot, hybrids. Look at Toyota stock, just absolutely flying over the last 12 months. That's where the market is now.
And the companies who are able to track the reality of demand are going to be more successful, right? I mean, is it basically a tell on how they can get ahead of where consumers are going to be, more than where the market will be, say, in 5 years?
Where the market is right now, shrugging off big time the numbers that we got just moments ago on the S&P 500. Equity futures here, positive by 0.2%, even with another hot inflation print. PPI higher than expected. Tomorrow, John Stolfus at Oppenheimer, Alcelinos of RBC, Sarah Hun of Alpine Saxon Woods, and Ian Lingen of BMO Capital Markets.
Welcome back to another special BNP Paribas Open update for Bloomberg TV and Radio from Tennis Channel. Emma Navarro clinched the biggest win of her career as she took out the reigning Australian Open champion, Aryna Sabalenka, closing out the victory 6-2 in the decider. Navarro making her first quarterfinal at a WTA 1000 event with her 18th win of the year. That's more than anyone else on the WTA Tour. And don't forget, Tennis Channel's daily live coverage starts at 1 p.m.
So most actors are thrilled if they have one part like Rocky in their whole career.
Yeah.
You had another one, Rambo.
Yeah.
Now, Rambo was not something you created, is that right?
No, Rambo was a novel by David Morrell. And I was the 11th choice. Everyone, it was like, I don't know who was next after me because they had gone through everyone. And it passed, including 3 different directors. So this had become sort of a pariah of sorts. The first time we go in there, Rambo was, in the original screenplay, was horrible. He was a psychopath. He killed children, he killed fishermen, this and that. So I said, if I'm going to get involved with this, I see the character going on beyond this. And they said, what do you want to do? I said, I want to rewrite the screenplay. And I want him to go right to the edge of violence, right to the point where he's being pushed, but he pulls back because, similar to James Dean in East of Eden, he wanted to be accepted back into the family of man.
So if Rambo got in a fight with Rocky, who would win?
Rambo.
Rambo.
Easy.
Because
not even a fight. Unless it's in a ring. See, first of all, Rambo is a killer, for real. He's almost a psychopath when that switch flips. Rocky is a good guy. He has mercy. The other one has no mercy.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Thanks
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From New York City for our viewers worldwide, I'm Danny Berger, in for Jonathan Farrow. It's the last piece of the puzzle before the Fed. PPI comes in hotter. Retail sales weaker. Another round of choose-your-own-adventure data that sends yields up with large-cap stocks holding on to their gains. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up, markets are digesting a busy day of U.S. economic data. Retail sales, they missed the mark, while another inflation print comes in hot. It fuels concerns that the Fed may be in no rush to cut interest rates. We begin with a big issue. All eyes on Chair Jay Powell.
If there's an upside risk here to the projections for next week, it would be to a little bit higher inflation, and maybe the median dots shifting up as well. But in general, I wouldn't expect huge changes from the statement next week or from what Chair Powell says in his press conference relative to what they've been saying recently.
Let's break down those numbers and get to Bloomberg's Mike McKee on this. Mike, it's something for everyone, basically, in this data.
Well, not necessarily for those who think the Fed should be cutting soon, because inflation is a little bit hotter. Remember, Jay Powell said, we want to see continued progress, doesn't have to be better each month. But he didn't mention the fact that it could be worse, and that's what we got with PPI. It was up 0.3 in January, up 0.6 in February, and the year-over-year rate goes from 0.9 to 1.6%, definitely going the wrong direction. The supercore rate there, 0.6, only 0.4, but on a year-over-year basis goes up to 2.8%. So this is not something to write home about, and I'm sure it will get talked about at next week's Fed meeting. Retail sales, meanwhile, a little bit weaker than expected. They had fallen in January. Most people attributed that to weather effects and expected a rebound, but the rebound is smaller than anticipated, just up 0.6 instead of the forecast 0.8. And the control group, the part that goes into GDP, just 0.0, flat on the month. We'll look for a revision there because those numbers are generally heavily revised. Maybe the story of the day, though, is jobless claims. The labor market we all thought was getting a little bit looser, but then look what happens. We go to 209,000 jobless claims, down from 210. This is like a 4-week low here. Continuing claims also falling. Although the previous week was revised much, much lower, it looks like people are getting jobs at this point, and the idea that people were losing their jobs and not finding new ones, getting harder to sell. Let's take a look at the PPI from the inside, some of the movers that we care about. The interesting thing about PPI for economists and for the Fed is a lot of it feeds into their indicator, the PCE, including in portfolio management, which was up over 5% in January, but only 0.2% in February. Health and medical insurance, though, up quite a bit, 1.4% during the month. I threw in eggs. It's not a big deal, but we know about a year ago this was a big deal. Yeah. Everybody complaining about the price of eggs. They go up 55% at the wholesale level. Quite interesting. Diesel fuel up 15.9%. This could be an issue for truckers going forward, and that could be an issue for shipping costs. We did see gasoline prices rise as well, but this is the first big jump that we have seen in diesel prices. Retail sales, a lot of weakness, pretty much across the board. Grocery stores down 0.1%, clothing stores down 0.5%. Building materials, one of the bright spots, up 2.2%. Rebound there because construction could continue with the weather getting better. Food and drinking places, the only services in the numbers, up 0.4%. It's the one number in there that tells you maybe things are not all that dire, people still going out for a good time. But it's interesting, this was not the rebound effect in the retail sales numbers that we expected.
Yeah, I refuse to go back to the days where eggs are a luxury. I just refuse to do it. Mike, thank you so much. Michael McKee. All right, let's get to the conversation now with Nuveen's Sarah Malik and HSBC's Max Kettner. Here we have again, we keep learning the lesson that the labor market is stronger or not as weak as we expected, and that inflation is coming in hotter. Max, we'll get to the market reaction in just a moment, but we had Tuesday a CPI upside surprise, Thursday's PPI upside surprise. What does this change, if anything, for the Fed next week?
I don't think for the Fed next week it changes a lot, right? It might be at the margin a little bit more hawkish, but, you know, in terms of perhaps the Fed, but also in terms of what the market thinks. Look, as long as we are still on track for rate cuts, I don't think if you're long equities at this point, it doesn't really matter whether they cut 2 or 3 or 4 times, whether they start cutting in May or June, or possibly only in September. That's not really the big deal breaker. I think the big deal breaker would be if you go from, you know, sort of 2 to 3 cuts towards 1 more hike, right? If suddenly they're starting to change their tune really dramatically, a little bit like they did last September. Remember, we're out of all of a sudden out.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
From the UK, and I'm the inventor of the Gel Razor. And today I'm looking for an angel investor to fund my project, the Gel Razor, whether that's a working concept and working prototype, or manufacturing possibilities with investment, or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I did that all in one. The idea is you pressurize the handle, the gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I want it to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
And then we're going into next year, the Fed starts to cutting maybe 4 or 5 times, and then they realize, actually, maybe we have to pause at 4.5 or 4%, right? And then that could be leading to a pickup in rates vol, and that then could be really putting a bit of pressure on multiples.
Well, that'd be unfortunate because then we'd miss the wonderfully bullish equities Max Kettner we've had for 2024. I'm starting to enjoy him. Sarah, I wonder what you make of that, because I know you list as one of your headwinds for stocks higher 10-year yields. And that's exactly what we're seeing. Yields picked up before today, some 30 basis points. We're adding another 4 to that this morning, yet equities are behaving. At what point do rates start to impact equities again?
I am worried about where 10-year yields are trading. They're well up above 4, crossing 4% here. And also another thing I'm worried about is election year volatility. We have 77 countries going to the polls, 60% of GDP voting. We know that in election years, markets tend to be more volatile, and the closer and less predictable an election year is. And with AI and misinformation out there, I think this is going to be one of those years with a lack of predictability around the elections. That's going to lead to more volatility for the markets. The two things holding up the markets here are basically employment markets and the economy, and of course, let's not forget earnings. So what we're seeing is the market has been broadening out in terms of returns, but I question whether that's sustainable, because if you look at fourth quarter earnings, which Max did mention, it was very tech heavy. Tech led earnings by about 15% revenue growth with the mega cap stocks and 60% earnings growth, while the rest of the S&P 500 was pretty weak, around slightly positive revenue growth and somewhat negative earnings growth. So we're not seeing that participation from earnings growth from the other 493 companies. It's unclear to me if we can get there given where interest rates are. And that's what concerns me about this market. It's trading at a premium. We're seeing some broader participation. It's not clear to me that that's going to be sustainable because the earnings just aren't there for the other companies to drive the markets higher from here.
Right. Sarah, Max, you're going to stick with us. We have much more to discuss. In the meantime, though, let's look at some of the stocks that are moving ahead of the opening bell. With that is Abigail Doolittle. Hey, Abby.
Hey, Danny. Well, let's start out with the shares of Robinhood because they are popping sharply higher. This after they gave an update on February operating numbers. Data was very strong. Crypto in particular, the stock up 11%. We also have Bernstein initiating with an outperform, saying that the company will benefit from a quote-unquote monster crypto cycle. Dollar General, in sharp contrast to Dollar Tree yesterday, up about 5%. Their same-store sales came in better for the quarter that was on strength in consumables. The same-store sales forecast is better, of up 2 to 2.7% versus the up 1.4% estimate. Apparently, growth in traffic and market share gains are really helping out. U.S. Steel, after plunging 13% yesterday, down another 5% in the pre-market after President Biden says that this company should stay American-owned and operated, basically coming out against that Nippon Steel potential takeover, the Japanese company. Perhaps more drama ahead there, Danny.
Oh, joy. Abigail, thank you very much. Okay, coming up on the show, we're going to get more insight, or we have more insight, and we're going to dig into it to the U.S. consumer.
When we look at the state of the consumer, when we look, say, at net household wealth in the U.S., it's making new all-time highs in itself, $156 trillion.
Retail earnings continue rolling out. We're going to break down the latest results for you next. This is Bloomberg.
thought maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future? I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
DOJ or other authorities.
Could face bigger challenges next.
Was going to keep rain World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
When we look at the state of the consumer, when we look, say, at net household wealth in the US, it's making new all-time highs in itself, $156 trillion. And obviously, you've got positive real wage growth also helping the consumer.
Investors are digesting a host of U.S. economic data. PPI came in hot, but a downside surprise in retail sales. It comes off fresh retail earnings this morning. We had Dollar General and Dick's Sporting Goods. Both reported sales that top forecasts, suggesting that consumers have kept spending on essentials, but they continue to be selective. Joining us now to break down that selectivity is Bloomberg's Simone Foxman. Hey, Simone.
Hey, Danny. Yeah, back to that retail sales data. It may really be bearing out what companies have been telling us all quarter. They've been offering a bit softer guidance for the year, especially in the first quarter. And so that 0.6% rise in retail sales, even less when you cut out gas and autos, may be indicative of that. We saw spending falling at furniture outlets, health and personal care stores, clothing, and e-commerce. Target's CFO said last week disinflation is the name of the game in retail this quarter. If you look at those earnings out today, they're following that narrative so far. Dollar General and Dick's Sporting Goods, as you mentioned, beating expectations, but maybe Wall Street had kind of downgraded its hopes going into these earnings as we get into the last earnings of the season. Dollar General expecting its first quarter to be the weakest of the year, but its fiscal year outlook topping expectations, with comp store sales expected to be up 2 to 2.7%. Dick's also beating on its top and bottom line in the fourth quarter. Fiscal year also seeing comparable sales up 1 to 2%. The expectation had been on the higher end, however. We'll also carefully be watching Ulta Beauty. It reports after the close its full year, its expectations for the full year is expected to be the lowest since 2021, but it's been in positive territory for such a long time, maybe the end of that post-pandemic revenge spending, Danny.
Simone, thanks for walking us through that. Bloomberg's Simone Foxman. Now, one contour of this American consumer has been the unevenness of it. McDonald's CFO Ian Borden weighed in on this, exactly what they're seeing, that consumers are working through dealing with all the inflation. Higher interest rates are having an impact. And this is key here for lower income consumers. You've got a couple of additional dynamics. Eroded COVID savings that people were drawing on and spending from that are largely gone. He was speaking at a UBS conference yesterday. Sarah Malik and Max Kettner are still with us. Sarah, we know that this recovery, that this growth coming from a consumer has been uneven. We're getting more warnings yet again about the lower end of the consumer. But at what point, if at all, does uneven growth mean unsustainable growth?
I think consumers are finally starting to feel the pain of higher inflation and higher interest rates. We've seen that for a while with more delinquencies on auto and credit card debt. That's finally now starting to run through. So what's left to hold up this economy? Strong employment markets, which so far we can count on, are important. But going back to the Fed of what they're going to do, I just don't think we're going to see rate cuts anytime soon. Even just looking at this week's CPI and PPI data, some of these numbers that flow through to PCE, which is the Fed's preferred barometer of inflation, like airfares and also auto insurance and healthcare, those are all up quite significantly within the numbers that we've seen. I think that bodes well to a PCE that's going to come in hot again, and that again kicks the can down the road for the Fed in terms of cutting interest rates. And going back to the consumer, that's a headwind for the consumer that's going to continue month 2 for retail sales. We may be seeing more of that with consumers pulling back.
Right. So, Sarah, if we're in this environment where the Fed isn't going to cut, the consumer is under pressure because of higher rates, they continue to be under pressure. What does that mean to asset allocation, specifically in stocks? Do some of those consumer names start to become less attractive?
Well, given that the broad S&P and also mega caps are trading at a premium, I think overall stocks are expensive. And so it's time to pull back and become a little bit more defensive when you're looking at equity. So we like areas like infrastructure, which is a cross between equities, public, and also real assets. That segment tends to be more resilient during an economic downturn. Also, it has contracts in place to pass through inflationary pressures. We like companies and sectors like that in this kind of turmoil and volatile period. Dividend growers, another area where you can get income. These companies tend to grow their dividend over time. And during down markets, dividend growers tend to perform better than the index tends to do if you look at history. But you get a lot of the upside capture from that too. I don't want to also just ignore fixed income here. There are higher qualities of high yield municipal bonds that have strong fundamentals. You can lock in yields that you haven't seen in years, sometimes even decades at this point. Right. And during tax selling season, municipal bonds tend to be a buying opportunity.
Going back to the consumer, Max, and I'll let you comment on that call in just a moment, but on the idea of the consumer, we have seen this. We have seen credit card delinquencies, to Sarah's point, above their 15-year average. We have seen auto delinquencies. They're about at pre-pandemic levels. Are you in agreement with Sarah that this is where we're starting to see some cracks or at least some weakness among the consumer?
Yeah, I think we're starting to see some cracks, but I would be not as concerned, I think. I would actually take perhaps, in some aspects, probably the other side of the coin. When we look, for example, at delinquencies, yes, delinquencies, credit card delinquencies as well are rising. But let's remember, they're still way miles below where they were on average before the financial crisis, right? So what we're seeing now perhaps is some of the exuberance that we had in borrowing during the COVID or during the post-COVID era, right, in 2021 and 2022. Some of that taking, or some of that really taking a bit of an effect right now. But I wouldn't be overly concerned there right now, because when we look at other things on the consumer, other stress indicators, look at private household insolvencies. It's the same sort of pattern, right? We're going back to where we were pre-COVID averages, but that was still miles below where we were before the financial crisis. The same thing is happening when we look at, for example, household debt service ratios, right? It's also been rising in the last 2 years, but it's just merely really at the averages where we were before the pandemic and still miles off where we were before the financial crisis. So I wouldn't be as concerned. And I would also stress what we've seen over the last, let's say, year and a half, with equities rising, with even house prices going up again, is a pretty substantial wealth effect for you as consumers. Probably, you as household wealth over the last 4 quarters has probably gone up $13–14 trillion with the rise in equities and in households. That's half a year's worth of GDP, for example, of nominal GDP, right? When you look at the distribution of that, it is actually the lower 20th percentile that's been benefiting from that. If you look at the buildup of net wealth since the pandemic, it's been particularly the younger households, right? Those up to 39 that have built up the most net wealth, the most net real wealth as well. So they are spending actually more money, they're consuming more. So I'd be actually not as concerned and would say, given that, the distributional effects have been favoring a bit more, the lower income households, the younger households, those ones that tend to consume more, in contrast to what we've seen in the 2010s, I'd be a bit more bullish on the consumer, and that sort of cycle can extend a bit further in the next couple of quarters.
And that is an interesting breakdown between the two of you, because Max, you like risk at this point. Sarah, you're more skewed towards that is income, taking some of the equity off the table, perhaps. Sarah, I just want to get your reaction to that perhaps things aren't so bad and we can stay in risky assets. I mean, the appetite in the market is certainly there when you look at things like credit spreads for triple Cs at a 2-year low.
Yeah, I mean, I think Max makes a good point. I mean, is the appetite there right now? It is. You look at equity market valuations, though they're trading at a premium versus history. His sort of threat on the consumer tends to feel pretty comfortable as long as employment markets are strong. So that's what we have to hang our hat on in terms of, can the consumer continue from here? You know, I'm worried about the second derivative here. We are starting to see these delinquencies picking up. We're seeing inflation that's sticky and a market that's at a premium. So that's where it becomes concerned. How much do we want to pay for what we have going forward, not for what's happened in the rearview mirror? I think going forward is risky, also with the 10-year above 4% and election year volatility, which tends to pick up. That makes me more nervous for the rest of the year. But remember, we came into this year expecting 7 rate cuts. That was what kicked off this rally. Now we're down to 3. If you ask me, will I take the over under on 3? I'll take the under on 3 because I think inflation is going to be sticky for a while. Having said all that, do we want to pay these valuations for this market? I think it's becoming much trickier from here.
Okay, well, luckily we can settle this with the dots next week. Sarah, Max, really appreciate your time. Sarah Malik and Max Kettner there. All right, SpaceX is getting ready to launch its test of the Starship rocket this year. It's the first of this year. It's the third. You're looking at live pictures there in Boca Chica, Texas, with the spacecraft atop of the Super Heavy booster. Let's get over to Bloomberg's Ed Ledlow, who joins us now, who's been looking at this. Ed, this is just a colossal rocket here, getting ready to take off.
Yeah, it's the biggest launch system ever built. It's the most powerful rocket ever built. And as we approach 25 seconds till liftoff, it looks very good that we're going to proceed with this. There had been a hold at the T-minus 40-second mark just to check out the wind. Let's listen in to the countdown.
T-minus 10, 9, 8, 7, 6, 5, 4, 3, 2,
30 seconds into flight, we are feeling the rumble. We are seeing 33 out of 33 Raptor engines ignited on the Super Heavy booster.
Booster and ship, avionics, power, and telemetry nominal. Acquisition of signal, Corpus Christi.
Continuing to get good call-outs. Our trajectory looking nominal, systems looking nominal. Just amazing to see all 33 lit up once again. At this point, we've already passed through max Q, that maximum dynamic pressure, and passing supersonic, so we're now moving faster than the speed of sound. Getting those.
Okay, so Starship, Danny, has reached the moment of max Q. That's the moment of maximum aerodynamic pressure on the combined system. The top half, the pointy bit Starship, the bottom half, the Super Heavy booster. SpaceX would tell you that whatever happens over the next 8, 9, 10 minutes will be its success. This is all about gathering data and making incremental progress. But the ambition here is at the 2 minutes 45-second mark-ish for the booster's engines to cut off, and then shortly after that have a hot staging where basically the Super Heavy booster and the Starship craft will separate with a controlled burn. Then the 6 Raptor engines at the base of Starship, which are insulated by a heat shield, they will ignite and the Starship will carry on its trajectory while the Super Heavy booster then starts a controlled free fall back down into the Gulf of Mexico. And we can get into some of the process, but what you're seeing, that's success right now. How far they get into their stated mission goals, we'll have to see.
What does success mean for SpaceX as a company with this mission specifically, Ed? Because this thing is the cash cow of them, right? I mean, here you have, as we were saying, this big starcraft, this big Starship, I should call it, that can fit a lot of cargo, fit a lot of things in it. So what does it mean for the commercial viability of SpaceX?
The maximum payload capacity of Starship is about 100 to 150 metric tons. As you see there, I think the Super Heavy booster falling back down. I'm just going to check. We've had stage separation successful, I'm just reading. So now Starship's continuing on its journey. This ain't easy, by the way. SpaceX feed, talking to Bloomberg's Danny Berger, doing all the same time. But the point is, you're exactly right, that the investors, our global audience, care about the economics of what SpaceX is doing. Starship can carry more stuff. That means that they can build out the Starlink constellation more quickly. That generates higher degrees of revenue. It gets them to more sort of solid ground on cash flow break even, and that funds the bigger picture goal for Starship, which is to carry humans to Mars in the long term, but in the short term to the moon in the first instance.
Well, there's this huge push for the moon, and Ed, we've seen that kind of be successful, kind of not successful in some cases. Last month we had Odysseus, that private U.S. lunar lander that, you know, yay, it lands, and then it kind of goes like this when it lands and collapses and doesn't quite work as planned. I mean, it's this huge space race, but this time it has the private bend to it. With each sort of venture like that that doesn't go quite as planned, what does that mean? Again, in this time where things are speeding up so forcefully.
Well, SpaceX and NASA are intimately tied on this goal of returning humans to the surface of the moon, right? I forget the year. It's been an early morning for me, but it hasn't been since the 70s that we've really talked about this idea of getting humans back into space. The first iteration of that is a non-manned, a non-crewed attempt for Starship to land on the surface of the moon. And as part of the Artemis program, then to follow up with Starship being the vessel that might get mankind there. You know, these might sound like sci-fi to a lot of our audience, but SpaceX is building out a program where Starship, because it can carry 100 to 150 metric tons, can take the materials to space and to the surface of the moon needed to establish a base on the moon. And that might sound, as I say, scientific to you, but that is basically the principles to which the Artemis program is aiming.
Okay, Ed, I have the date for you. December 19th, 1972 was Apollo 17, the last time they went to the moon. I
wasn't around then, full disclosure.
I mean, I wasn't either, so it's okay. We're on the same page here. Neither you or I remember the last moon landing because we certainly weren't around. Okay, so let's say we have success here. The commercial viability of SpaceX, it increases whatever fold. What next? What does SpaceX look like as a standalone company? Is it an IPO? Is it something different? What is the future for them?
So in the last tender or secondaries round that SpaceX did, the company was valued about $180 billion. And what I've reported with colleagues is that 2024 is the year where revenue contribution from Starlink outpaces revenue contribution from the launch business. Remember, like, SpaceX makes money from government contracts and private contracts to carry stuff, payload, and human payload into orbit. But really, the money is in Starlink, right? This is a satellite constellation-based internet service where consumers pay a monthly subscription and also a one-time fee for a ground-based receiver. The hope of investors, and it's been downplayed by Elon Musk, is that the Starlink portion is spun off in an IPO. I've reported that the groundwork is underway. Starlink is being moved into its own separate legal entity, a standalone company, if you like. And there is some thinking that 2025 is possible when it comes to a Starlink spin-off. Musk has really downplayed that because, one, he has no problem raising capital from the private markets, but also, two, sorry, I'm just taking a look at my screen, and that is the booster, super heavy booster, falling back down into the Gulf of Mexico. What they're going to try and do here, Danny, and sorry, I know I'm going on here.
No, please
what
do.
they're going to try and do is they're going to simulate the landing process of the super heavy booster, do the controlled burns to right it, put it the right way up, but they're still going to crash it into the Gulf of Mexico. They're not going to try and recover any of the hardware here. And final point in the space IPO, investors would love a piece. Elon Musk's basic point has been, I'm not going to spin off that Starlink unit until I have clear visibility on positive cash flow, which sounds a very sensible and prudent thing from Elon Musk, who is not often sensible nor prudent.
Yeah, and Ed, you know, I'll let you have a moment here just to kind of look at everything and make sure everything's going to plan with that rocket launch, because I know it's a lot to keep track of from, you know, my own amateur eyes. At least what we're seeing so far perhaps looks like it's gone to plan. I know you were saying that one piece was coming down there okay with crashing it into the Gulf of Mexico. So Ed, would be great to get an update from you just where we are at the moment. But secondary to that, I know each of the prior launches did end up with pieces of the Starship blowing up, and that led to an FAA investigation about their systems and environmental impact. So when it comes to regulatory impact, what could we see from this, whether it goes to plan or not?
So we are at the 8-minute mark. The Super Heavy booster, we've had confirmation, did splash down in the Gulf of Mexico. After the fact, there will be an investigation on how successful the process of simulating the booster landing was. What I think we're looking at now, and you hear cheers from the SpaceX staff, is that Starship's 6 own Raptor engines have now shut off. And what represents progress in this mission is that they will try later on to reignite the boosters on Starship, which has not ever been done before. What we're looking at in real time is just astonishing technological progress on what's happening. This is the 3rd attempt to get the Starship system into space. This last time what happened is that they got to an altitude of about 150 kilometers, traveling at a speed of 24,000 kilometers per hour, which is about 15,000 miles per hour. And there was an anomaly which the automated system detected, and then basically the Starship self-destructed, for want of a better description. It has not done that so far. They keep going, and there are a number of tests that they want to do while Starship is in space. They've gone through the ascent burn of both stages. What they want to do is try and experiment by opening and closing the payload door. So we talked about how Starship can carry 100 to 150 metric tons. Basically, in the context of Starlink, there is a little slot at the top of Starship. And in the future, to deploy those satellites, I'm relying heavily on my hand movements here, but they'll just come out one by one, just like that. So they want to practice the current design of that payload door. That would be a huge success. And then, as I said, one success point would be to reignite the Raptor engines. I don't think they've done that yet, though I'm looking for confirmation. It's already surpassed the length of those 2 prior tests. So this is astonishing technological progress we're looking at.
Yeah.
And then the final test, well, what I'll leave you with is, if we're ever going to get to Mars and indeed the moon, it's one thing getting Starship into Earth's, outside of Earth's atmosphere and into orbit, but you're going to have to refuel. What that looks like to SpaceX's mind is having 2 Starship spacecraft in orbit. One of them will be a fueler, a loader, full of propellant. They will dock in space, on paper, in theory, and the refuel process will happen in space. So an element of what they're going to test today is that refueling process. And I think because we only have the downward-facing camera, and I'm speaking over the SpaceX feed, it's going to be hard for us to know progress until after the fact.
Right.
But we're doing a pretty good job 11 minutes into this launch.
Hey, Ed, I'd say you're doing a pretty good job. Let's be clear where the legwork is coming from. But I want to get back to this idea of the FAA investigating SpaceX for the prior rocket ships blowing up because of pollution. The New York Times had this great story to start the year, basically saying that there was a study in 2022 that said if the rate of rocket launches increased by a factor of 10, and so far they're increasing quite rapidly, their emissions could cause temperatures in parts of the stratosphere to rise as much as 2 degrees Celsius. Ed, of course we have to celebrate the technological advances that are coming from this rocket-type launch, but how do we balance that with the environmental impact?
Yeah, I mean, one of Elon Musk's rationales is that long-term, the continued existence of the human race depends on us being an interplanetary species. So acknowledging the risks of long-term climate change on the planet Earth, that's his kind of big picture goal, but we're talking well beyond your and my lifetime, Danny, well beyond. I think that's the big picture. But the reason that after the last 2 tests, test 1 and test 2, authorities investigated the near-term environmental impact is simply that the explosion propels debris across a wide range of area, right? The test launches are highly controlled. It's why the FAA has to issue licenses. And in the Boca Chica area, the environmental impact of that debris and the byproducts from combustion are assessed, literally in terms of the impact of the wildlife, flora and fauna in that area. But you also have to acknowledge that these tests are tightly controlled, right? The airspace in and around Boca Chica and Starbase, heavily controlled. One of the reasons we were slightly delayed this morning is that there were boats in close proximity in the Gulf of Mexico, and they had to kind of be shooed away. All of this is kind of normal procedural stuff, although it's also important to acknowledge SpaceX would like to move much more quickly than they are, and one of the limiting factors is the authorities doing investigations such as these.
One thing I think is important to point out, we're looking right now at the control room. I seem to have noticed some green hats there, and I think someone had a 4-leaf clover on the back of their T-shirt, so it looks like it's
St. Patrick's Day.
Yeah, I was going to say, I think it's a St. Patrick's Day kind of launch, so hopefully they get some of the luck of the Irish and things going as planned. And going back to the Odysseus moon lander that had not exactly a crash landing, but not exactly a perfect landing, I mean, is there any real competition for SpaceX, for private space at this point in terms of advancement and just the amount of testing and these types of launches that they've been doing?
No, not if your criteria for success is judging ability to take payload, either human or non-human, to orbit and beyond. You will have seen the other big story in the space industry this week was Japan testing its solid fuel-based rocket, which exploded pretty shortly after liftoff. The reality is that SpaceX accounts for the vast majority of payload to orbit. In other words, and in layman's terms, SpaceX does most of the launching, putting stuff into space. There are others that are trying to catch up. Rocket Lab is a publicly traded example, but Rocket Lab is nowhere near the stage where it could carry humans, as an example. Then you had the kind of legacy aerospace names, United Launch Alliance, Boeing, et cetera, and the work they're doing, and they're nowhere near.
All right, Ed, we're going to leave things there as they go through the rest of this test flight. Thank you so much for that. That is Bloomberg's Ed Ludlow. Again, SpaceX Starship has launched into space. It's already surpassed the length of the prior 2 tests. So far, success for Elon Musk and SpaceX. This is Bloomberg.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited, finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Do you feel like this age of abundance over the last few years of just how much was being made?
For my personal taste, I am thrilled at what I get to find every night if I have time to look for something. So I personally don't think too much was made. I think the customer will tell us when there's too much made and they won't watch things. And I think part of the misalignment I talked about before is imagine if things didn't get picked up or movies didn't get made that people didn't watch or go to see. That's how it used to be. The customer decided. I do think there's going to be less made in the middle price range. I think there's going to be more made in the higher price range because when you get to global events like Barbie or Oppenheimer or Super Mario Brothers, it's worth the investment, and it's clear that the audience is there, and they just need to be given what they want. The middle, which ends up, quickly on one of the services in a way that we're watching movies that we don't know how they got made or when they got made and all of that. I think that will probably be curated better, and I hope there's more inexpensive things that give more people the chance to have their work seen.
About 13 minutes into your trading day, this is the state of play. Stocks are resilient against the face of hotter than expected PPI after that hotter than expected CPI earlier in the week. NASDAQ outperforms up 0.3%, while small caps, they cannot hang. If we're looking at less cuts this year, perhaps that's where the pain is. Those are down 0.5%. But stocks are also moving higher in the face of higher bond yields. Check out what's happening across the curve. We're moving up by as much as 6.5 basis points for the 10-year yield. This is now the fourth consecutive day of higher yields. It is the story of inflation peaking up more than we had expected and what that means for the Fed's trajectory. But again, there is a split here between how bonds are reacting. Again, we're at 4.25 on your 10-year yield and higher large cap stocks. Now, to try to get at why there's that difference, JP Morgan's Jack Caffrey has been summarizing the market over the past month, writing that equities are likely to be supported by good economic news overall, as good news supports estimates. Bond traders are likely to think the good news is bad news, and they're pushing out their slowdown in estimated Fed cuts. Pleased to say that Jack joins us now. Jack, so wonderful to see you on the program today. And that is just the perfect encapsulation of what's happening today, because bonds are in pain and stocks are not. So is that what's going on, that stocks are okay because maybe this is good news?
Well, I think, if we try to dig into today's economic news, we will wind up seeing hotter PPI. Hotter PPI is some companies' costs are higher, but one company's cost is another company's revenues. And I do think that stronger revenue burn, if you will, or continued growth winds up actually being supportive of estimates. Companies went 20 years without really having to look to the pricing lever. They now have it. I think they're going to be a little bit slow to give it up. And to the extent that is the case, then the fixed income markets have to recalibrate what they think about. And at some point, we will wind up with a little bit more of a tug of war between the higher certainty of fixed income versus the prospect of better earnings growth to go forward.
We were speaking with Max Kettner of HSBC earlier in the program, Jack, and he basically said that the reason that stocks aren't reacting is because, sure, rates have been slowly moving up, but it's been a slow burn higher, and it's not volatility. But if rate volatility were to come back, then you'd get a reaction from equity markets. What do you make of that?
I think that ultimately the linkage that we're going to see, because the two markets' volatilities look disconnected. Equity volatility is plumbing post-pandemic lows as though there's nothing to worry about. Don't worry, be happy. And that there'll be no liquidity concerns if we change our minds. If you look at fixed income, though, implied rate volatility is running twice the levels we saw before the pandemic. And so you dig into that. There's so many bonds out there with still very low coupons. The math is that bond prices have to be more responsive to those changes. If the change is slow, we can calibrate and things can move forward. But if there's a shock, if you will, likely we'll see yields spike. Yield spiking will probably then work its way back, leading into some concerns in the equity market that, that higher yield eventually creates a hurdle that equities can't surmount, and people might be more comfortable buying bonds. Not to say we're going to see a 5% 10-year, but you have to start thinking the possibility of that becomes more and more likely every time the yield of the 10-year backs up 1 or 2, 3, 4, 5 basis points. I'm just not sure where that break is, but equities right now certainly are happy having the pricing power and being able to try to use it.
I love what you write, Jack, that we had this environment before the pandemic when corporates benefited from efficiency. Then we get higher inventories. They don't get that efficiency, but they get that pricing power. This all ties in with exactly what you've been saying, Jack. So if we're on a trajectory where inflation is coming down, efficiency still being worked through, where do corporates squeeze that growth from?
To some extent, it's the corporate sector has to start looking to more capital spending in order to try to find that next layer of efficiency. If we think back to the 2000s to 2010, corporate sector could certainly find efficiency by outsourcing production to lower wage regions. To the extent we talk a lot more about nearshoring, friendshoring, the excitement around AI and making things more efficient, I think ultimately companies are going to have to spend money today to become more efficient into the future. I think that ultimately winds up being productive in two ways. One, it's more workers getting paid more in the United States if you nearshore or onshore that capacity. And second, that capital spending tends to be nicely profitable for other companies. So I do think you can create a bit more of a virtuous cycle rather than cut your way to prosperity that worked well for 20 years towards maybe now spending your way towards prosperity and balancing how disciplined you are around that spending, a little bit for the company, hopefully a little bit for shareholders in the way of dividends and buybacks.
Jack, we have to go back to what's happening with duration right now because this is a significant move, 7.5 basis points higher when it comes to the 10-year yield. That's the biggest move since we had the CPI surprise of last month of February 13th. We're going to get the Fed next week. All it will take, this has been written at maybe by ad nauseum so far over the past few days, but all it takes is for two voters to change their dots, to shift their dots lower, to shift the overall median of this dot plot. If that is indeed what we get next week, what sort of recalibration needs to take place in this market?
Well, I think the fixed income market's been trying to get their handle around the good news is actually, equity's good news is bond market bad news. And I think they've so far managed to do that on a very measured basis, looking to, if you will, the shifting forward guidance and the forward guidance following the data. It's been a very data dependent market in that regard. Again, I come back to what does it take for the bond market to suddenly say, oh, it's 2. And I don't think that will be necessarily as problematic as continuing that discussion of, well, what if the next move actually is a hike? That has been sort of a very low rumble out there that I don't think anyone really wants to contemplate, but you hear people talking about it because it's provocative, because we wanted to think that we were done with inflation. The reality is inflation has been a very controlled descent, perhaps a little bit too controlled and taking a little bit too much longer than many people wanted to think. And marginally, I think it remains uncomfortable for the Federal Reserve because I think they would rather not be so much the locus of everyone wanting to talk about who does what, when, why, how many cuts, when will it happen, when do they shift their policy. People want to believe on momentum of policy, and they're not getting that shift that people are looking forward to. But Jack, that still said comes back to the reason we're not getting it is because the data's been good.
Yes, and to that point, Jack, you say that no one wants to contemplate the next move being a hike, but it's clear that, I mean, you say other people are, but it's clear that you are to some degree. The data coming in this way, if it continues, is that enough to shift, again, this momentum to not how many cuts, are there fewer cuts, but is the next move a hike?
I would argue that is ultimately how you take what a market that's been, more or less in less than 3 months, we've generated the return that so many analysts and strategists were talking about getting for the entire year. So it's been the Magnificent Seven driving it. That's been the good news. And I think within, you're starting to see more companies starting to see their stock prices perk up and start to participate. That all said, the fact that we have come so far so quickly, 8%, 8.5% year to date, 24% effectively over the prior 4 months, we're going to have a bump. And I do think to some extent, some realization around that bump might come more from the bond market, looking at having the time I've been talking, we've seen a 50 basis point reversal in the S&P. So I should probably shut my mouth.
I was going to say, Jack, I think we might have jinxed this because as we were talking about the resiliency of markets, quickly, just only a few seconds here. But
You're killing me, Danny.
But what do you make of that? I mean, this is a volatile market. It's decided to maybe start caring about PPI now.
Well, I would say actually the equity market isn't a volatile market. And in that regard, we've gone 270 days without a 2% sell-off. Not a record, but that's a long period of time, effectively. It's a trading year. And so that I don't want to say it's a complacent market, but it's a market that continues to look for the good. It's been finding the good, and it wants to continue to let that effective underpinning momentum carry its way. You're going to get a blip. And I think the blip probably comes more from the bond market than the equity market right now, based on
it's been 6 years. I mean, it's been the longest streak in 6 years that we haven't had a 2% or more sell-off. I believe that's the stat. Jack, really great to catch up with you this morning. Jack Caffrey of JP Morgan. All right, let's get to the sector price action this morning. With that is Bloomberg's Abigail Doolittle. Hey, Abby.
Hey, well, Danny, with this decline of 0.3% on the S&P 500, we now have most sectors lower, 10 out of 11. Only energy is higher. Real estate, utilities, both down more than 1% as yields go higher. And then relative to some interesting news earlier, we do have the shares of Anheuser-Busch dropping significantly, weighing on consumer staples. And this on the news that Altria sold shares. So volatility is the theme of the day.
Yes, it is. Abby, thank you so much. Coming up, we're going to look at the market moving events. That's next. This is Bloomberg.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
This is Bloomberg. Let's get to your trading diary. What you need to be watching this week. We're going to get earnings from Adobe and Ulta Beauty later today. President Biden then will participate in a campaign event in Michigan. Tomorrow, we round out the week with the UMich Sentiment Survey, and we also get U.S. Empire manufacturing data. But the theme of this week has been inflation surprises to the upside. It happened with CPI on Tuesday. It happened today with PPI. The impact, yields moving higher by nearly 8 basis points across the curve. Equities turn. S&P 500 down by 0.4%. This was the countdown to the open. You're watching Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on that folks are so excited about it. Climate tech is the hottest area to be in.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Your fixed income fix. Watch Bloomberg Real Yield at its new time, Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Thursday, everybody. We like to hear and call it Friday Eve. That's sort of our thing. So happy Friday Eve. I'm Alex Steele here with Jen Ryan. Paul Sweeney is off this week. Okay, so you have a market that's trading heavy now. Yields up, stocks down. That's pretty much the takeaway from that PPI and retail sales number. Let's dig a little deeper here with a business flash with John Tucker. Happy Friday Eve.
Well, happy Friday Eve. Yeah, talk to me tomorrow. We're being brought to you by Interactive Brokers. IBKR's redesigned Fundamentals Explorer provides comprehensive worldwide fundamentals data to clients at no cost. Take your research to the next level. Visit ibkr.com. Right on the screen right now for the risk assets. Broad-based increase in producer prices. At the same time, soft retail sales. And then you had the revision of the prior jobless claims numbers now shows what looked like a decline in continuing claims was actually an increase. Take all that, put it in the blender, put it on frappe, or the high speed, and the S&P 500, 10 of the 11 major industry groups lower right now. Real estate, that is proving to be the biggest drag. Energy and information technology, the only two groups that are rising for right now. Savita Subramanian at Bank of America, meantime, she maintains a year-end price target of 5,400 on the S&P 500.
When you look at margin pressure that we were all worried about a couple of years ago, we've seen corporates navigate that fairly well. And then I think, you know, the sort of the underpinning for our more positive outlook is that we are back to a more predictable earnings environment.
Right now, the S&P 500 was higher earlier after the release of the economic figures. 26 points low right now. That's down 0.5%. We're at 5138 on the index. The Dow Jones Industrial Average, 180 points lower. And right now, the NASDAQ 100, 97 points lower. That is down just about 0.5%. Fed swaps trimming the odds of policy easing. Cuts now likely starting in July. We have the 2-year up 3 basis points, 467 on the more policy sensitive part of the curve. The 10-year, the benchmark, 6 basis points higher. That's at 425. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. And that's your Bloomberg Business Flash. Jen and Alex.
Thank you so much, John Tucker. This is not going to help your 30-year mortgage fixed rate that you're looking for, is it?
It is not. It's all turning against me.
It's all, yeah, the tide is not good right now for you and buying
What was
a house.
yours again, Alex?
Oh, don't do this to her.
Yeah, don't do this to me.
But I'll talk about it. 2.75%.
You were going to bring it up anyway.
I totally was.
Well
it was November 2020, 2.75. But like, I'm never moving. None of those things will happen. You have flexibility. You have options.
Looking on the bright side,
Hey,
that's
look, if the-
Alex for us.
Yeah,
If the
she's
price
looking
is
at me like
right,
she hates me.
I got a place for you. It comes with 2 kids. You can keep all the furniture, the dog.
Yeah, but will there be an
All
extra
yours.
closet, or is that going to get turned into a bathroom?
At this point, you could do either. I'll have the rough plumbing in, so you have an option.
So basically, John Tucker, for those of you who don't know, is turning a closet into a bathroom. And like, I understand the idea of why he's doing it to like whatever, but I don't know. To me, that's bananas. That's like a shoe closet, not
No,
a
you have the
bathroom.
option. It's just I just want in the future
An
the
option.
option there. So the rough plumbing will be there if you want to. If somebody else wants to do that. So
I see. Okay, whatever. I think it's weird.
I have one pair of shoes.
I know,
It's like,
it's
what
true.
do I need
You
a
have
closet
2. Do
for?
not undersell yourself, guys.
A pair of
You have
sneakers
2,
and a pair of dress
and we've
shoes.
seen them. All right, let's get back to these markets here. Abigail Doolittle is joining us. I mean, I want to say that we're going to see a sell-off, but I got to say, just down, 0.4% is nothing to get too excited about.
It's not, but we were higher earlier.
It's true, we
and-
did reverse, yeah.
Yeah, so it's interesting that the initial stock reaction to that warmer or hotter, however you want to reference it, PPI number and in a little weaker retail sales, which you would think would be good around the inflation. Initially, investors not really doing much with it. Stocks basically up just slightly, and then sort of out of nowhere, out of the last 15 minutes, we see this decline. The S&P 500, to your point, down 0.4%. We have the NASDAQ 100 down about the same amount. Where the selling is coming once again, it is NVIDIA down, let's see, it is down 3%, so the SOX is down 1.2%. NVIDIA is close to making a technical breakdown. If it should go below 842, let's call it 840, somewhere in there, that's the last true low. We could see some intense selling pressure to the point that the stock will close the gap up on its last earnings report. That would basically be an entire rethinking of investors in terms of what they heard. Interesting, though, on the other hand, you have Apple up. So Apple up about 1%, I believe. So we've had some technical weakness there, but some of the buyers stepping in. It seems as though the sellers are giving another break. What's standing out to me, not a huge influence on the markets right now, the airlines, American Airlines is down 6%.
Oh, wow.
And I mean, this couldn't be the reason why, but I'm seeing headlines here about American Airlines making an emergency landing. The reason I'm saying that that would not be the reason is, that's unlikely to affect their profit outlook. Typically, when that would be some headline risk. But airlines overall down, so I'm going to have to do some digging on that space for sure.
Can we go back to NVIDIA for a sec? Because
Yeah.
I'm really intrigued by your point about the looming technical indicator and the potential for really hard selling. What would that mean for the rest of the Magnificent Seven, for the rest of the big tech space?
So it's interesting. We spoke yesterday, Shonali and I, to Alon Rosen, who's the head of institutional equity derivatives over at Oppenheimer, and he was saying that if NVIDIA falls apart, the rest of the market is likely to as well. He didn't have anything specific relative to derivatives, but I think what he was talking about was the sentiment. So the idea that this stock has been the glue to the rally out of the October 2023 and October 2022 lows, the AI craze, that if for some reason it all of a sudden came under intense pressure. And I can make the case, I think I was making it to Carol and Tim the other day, that so this stock, and I'm going to have to present this chart soon at some point, it is almost 100% above its 200-day moving average. That is a way of saying it's almost doubled this year, which is just ridiculous. I mean, it's 2.5 months in, so too far, too fast, even though it is such an impressive company, the AI, some saying that valuation's not a concern. With the stock down, others are weighing in, saying, yeah, the stock is just a little bit too rich here.
Interesting that you mentioned the airlines. I wonder there was that conference earlier in the week too, and then
Yes.
Southwest announced they lowered their guidance. I feel like it's just hard to maybe recover
Yeah, that's a
little
great
bit.
point, because investors could be weighing that in now and starting to sell positions. Yes,
Yeah.
great point.
What about the Russell? Like, I obviously underperformed today, right? So it's off by over 1%, et cetera. Is there any technical indicators that you need to be watching to see if we do have a breakdown on kind of these value names?
The main thing I would be watching with the Russell is the divergence with the other indexes. It's been about 1.5 years since it's put in a record high. If this index continues
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level up your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
Really struggling to find a path to win for both them as well as consumers. As I said up front, it's a super challenging environment. Retailers have to find the right way to promote. And when they all have the same strategy, it's hard to win. And pretty much when you talk to any company out there, they've got a plan to win in an environment that's largely going to be stable or flat to down. So they truly have to find a differentiated way to meet that consumer where they need to be met to win. Whether that's a differentiated way with products, which is also pretty interesting. If you look at retailers, over 40% plan to carry less products, but higher performing retailers carry more product, which really speaks to consumers valuing choice and differentiation. So lots of different strategies. It's really going to be challenging to find the right one to win.
Yeah, I would find that to be so hard, like so much that you have to anticipate and then stock up. And then if not, you're looking at 80, 85, 90% discounts, which I love, but can't be good for an investor. Who would you say has a good strategy? Like, what's a good formula to emulate?
Right now we see consumers, I talked about consumers paring down. I think discount retailers are having a really good day, and it's making it pretty challenging for mainstream retailers. So mainstream retailers need to look at why consumers are going there. Is it purely price? Is it the ability to one-stop shop? Is it the ability to, the environment of the retailer? So retailers need to look at, or is it their online strategy? So lots of different things to look at, but who's winning are largely discount retailers.
Could you give us a sense of the bigger picture here for consumers? Because, I've certainly read a lot about consumers moving away from stuff and towards experiences, but everything is so expensive right now. So, you're mentioning that it's the discounters that are winning, but that's a very, sort of concentrated area in retail, I would have thought. So, is the thought there that retail is just perhaps too big?
That retail is too big? No, I think it's more that retail is really varied. So I would say, in response to your question about what does this mean for consumers behavior today is so drastically different than it used to be in 2019 in terms of, what we buy, how we buy, and when we buy. Think of online, think of discount, think of being in the home versus outside the home. So the future for consumers is that continued shift, towards more value-based living, I'd say. One thing that we talk about often is the baking aisle. In 2019 in the grocery store, that aisle gathered dust. And now it is the hot spot. Over 2020 and 2021, we actually created a lot of bakers. And today it's really one of the fastest growing aisles in the store.
I did the baking thing before, and then during the pandemic.
You were ahead of the curve.
I was ahead of the curve, says no one ever. But
what is it to bake? What is it you bake? Like a chocolate? I happen to love chocolate cakes, so.
I actually have a fantastic chocolate cake recipe that is super easy to make.
I don't want the recipe. I want the cake.
No, I'm not going to give it to you. I'll bake it at some point. But I actually do like baking like bread and croissants and things like that. But anyway, that was hard to do during the pandemic. Before we let you go, so I got to say, I go out to eat, 2 adults and a kid, and it's like $300. It's bananas. And I'm not talking like a super fancy restaurant. Like I'm talking like the neighborhood place. At what point do you think that that's going to top out, and then we're going to see people sort of readjust, and then all of a sudden the stay-at-home stuff comes back?
Yeah, I mean, right now, out-of-home food prices are higher in terms of their increases than in-home. And so it really is making it challenging for families to do more things outside the home. That has already contributed to increased in-home consumption, which will continue to grow if we continue to see the outside the home food prices elevate.
That's really interesting because I feel like restaurants are just getting so squeezed. They've got the staffing issues, they've got the food costs. And so consumers just want a break, but cooking at home has its own challenges. And you're mentioning the point about food at home, and people are so pressed for time. It's kind of like one of those things. How do you trade that down?
I sometimes feel like the world that we're living in today is so circular, right? So the cost have increased everywhere, and it continues to go to be passed around, right? So restaurants are paying more for their products, for transportation and distribution of the products, for their labor, and they're having to pass as much as they can on to consumers who in turn can't really afford that and are cutting back. And so it continues to have a circular effect on the overall economy.
Well, great stuff, Jill. Really appreciate it. Thank you so much, Jill Blanchard, President of Enterprise Client Solutions for Advantage Solutions, talking about that weaker retail sales. But even going to the grocery store is expensive too. I mean, the whole thing.
It is nuts, as you say. And then the thing is, you kind of can't win. You can trade down, but it's still even expensive at the lower price supermarkets.
Ain't that the truth? All right, we will be disgruntled about food prices, I'm sure, later on in the hour as well. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. You have stocks lower, yields are higher. We had evidence inflation remains elevated. Prices paid to producers rising in February by the most in 6 months. And the Fed swap showed traders now pushing rate cuts from the Fed to July from June. Some of the stocks on the move today. Dollar General higher after issuing a better than expected annual forecast for comp sales. Under Armour shares, they are sinking right now. The ticker UAA down 12.5%. The company announced, among other things, the return of Kevin Plank as the chief executive officer. And then you have shares of Oracle right now. They are up 1%. On the move after Argus Research upgraded this software company from hold to buy. S&P 500 down just about 12 points, down 0.25%, 51.52 on the index. The Dow Jones Industrial Average, 104 points lower, that's down 0.25%. And the Nasdaq 100, 31 points lower, that is down 0.2%. And as Alex pointed out, the real move in the bond market, the 2-year up 4 basis points at 4.67 after that data this morning. And then the benchmark, the 10-year, 8 basis points higher right now. That's at 4.27. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Alex and Jen.
Thank you so much, John Tucker. So one stock to watch is U.S. Steel. It's down another 1.3% today. President Biden says that U.S. Steel should stay an American-owned and operated company. This is Nippon Steel over in Japan is trying to buy the company. J.P. Morgan now saying that it is possible that Cleveland-Cliffs could rebid for U.S. Steel. So it's a lot. It's a lot happening. At the end of the day is we need the steel. We want to produce it. Prices are not that great. Therefore, the consolidation. Therefore, a backstop. Who better to talk to? Richard Burke, Bloomberg Intelligence, a senior analyst. He covers basic materials for us right here at Bloomberg. Richard, how did this whole thing, I don't want to say fall apart because it hasn't fallen apart, but like, what happened?
Really politics.
Oh, what? That's so weird.
If you look at it, U.S. Steel is located in Pennsylvania. Biden won Pennsylvania by a little over 80,000 votes last election, 2020. Steel union members in Pennsylvania are about 750,000 union members in Pennsylvania.
And they don't necessarily want this deal to go through.
And the union does not want the deal to go through. And you also had Trump come out saying that he would block the deal. You know, there's 3 or 4, I'm not a election expert, but there's 3 or 4 critical states that probably will flip the election, and Pennsylvania is probably one of them.
So I guess I'm sort of wondering, knowing that that is the politics of the situation, what was the motivation to bring the deal in the first place?
The motivation is, if you look at the U.S. steel market, is actually with the Infrastructure Act and Inflation Reduction Act is actually probably one of the more higher growth steel markets across the world. And Nippon Steel has said that they want to get to 100 million tons of steel production a year. This was it, kind of help them along that goal.
Without them, though, could they not do it? And is it because it's just expensive to get it done, or is it because the prices are low, so their margins are not great?
Not quite following.
Oh, that if the Japanese company Nippon Steel went away and they you need all this product here in the U.S. to help satisfy all the Infrastructure Act and the CHIPS Act. Without a buyer, why can't U.S. Steel just do it on their own?
No, U.S. Steel can't do it on their own.
They can. Okay.
And they have outlined a plan to get there, to improve their assets and build up. They're building another plant in Arkansas, Big River Steel 2, which they built. But back in August, Cliffs kind of put them in play. Cliffs came in with an offer for $35 a share, kind of put U.S. Steel, said that they had to evaluate strategic alternatives, spent a few months doing this, and then came up with where Nippon was the highest bidder.
So I guess if you've got these competing bids for it, I mean, what's the expectation for how long this can go on?
Well, it's currently under review by CFIUS, which is the Committee for Foreign Investment in the U.S. CFIUS deals with national security. So as people said, their deliberations are shrouded in secrecy. So, initially when we looked at the deal and we saw the union opposition, we said what they should do is U.S. Steel and Nippon should slow walk the deal, slow walk the approval, get past the November 5th election, and then maybe, politicians' attentions turn elsewhere.
But is it possible that U.S. Steel says, all right, laters, and they're just going to go on their own way?
I don't think shareholders would appreciate that.
So now they're like, okay, we want to get
Right.
something.
I mean, the steel, the stock was trading like in the mid-20s, and you got a deal for $55 a share.
You want to take that. You want to get something.
Right.
I guess my question is, let's pretend that the Nippon deal falls through. Let's say Cleveland-Cliffs comes back in and rebids, right? And the company's like, all right, I guess we're up for sale. Is the U.S. government gonna like that deal? Because that's gonna be antitrust concerns.
Right. That switches from national security over to antitrust concerns. And also the other thing, one of the areas of antitrust which would come under scrutiny, U.S. Steel and Cleveland-Cliffs are two of the biggest suppliers to the auto industry. So you have the auto companies, not happy with the deal there. So.
To go back, though, to the politics of it, just thinking through some of the opposition to the Nippon bid, because a lot of that had to do with the objection from the steelworkers. Correct. So if you think of an American bidder coming in, do you think that's an easier thing for steelworkers to accept?
Well, Cleveland-Cliffs has a very good relationship with the Steelworkers Union. So that's why the union has been favoring Cleveland-Cliffs. In fact, in the union agreements, there's a thing called right to bid, where if a company with the U.S. Steel has a contract with the steel union, gets acquired by somebody, the union has a right to bid. So in this whole escapade, the U.S. Steel Workers Union assigned their right to bid to Cliffs. So favoring Cliffs and things along those lines.
Can I just ask, what's the fear of a foreign company owning U.S. Steel? I mean, Nippon Steel is going to pack it up and move it to Japan?
Well, especially because Japan's supposed to be like a friendly country. And
it's not like they're going to raise prices to the point where they're going to shoot themselves in the foot to have sales decline. I mean, part of this is jingoistic, isn't it?
Agreed, and also Japan is the number one foreign direct investor in the United States. U.S. has over $5 trillion of foreign direct investment. Japan accounts for 15% of it. So it's the biggest foreign direct investor in the United States. So on that, it doesn't really make sense either.
Hence, just pointing out the whole union politicking of it. Okay, so what do you think actually happens? Best guess.
Best guess? I think you got a lot of smart people at both companies. I think, like I said earlier, I would slow walk the deal and
sit tight till November something.
Get past the elections and see what happens. You're probably going to have to pay the union a little bit more to get them on board. But Nippon Steel just cut a deal 2 to 3 days ago with the unions in Japan. So obviously they realize the worker landscape of wages are going up.
Oh, you know what? I wonder if the financing picture will be a little bit easier if they can slow walk the deal and get it past the election, because looking at the Fed dot plot, we could have had a couple of interest rate cuts by then, so maybe it'll be a bit cheaper.
They have everything already aligned. Companies have, signed up to provide them the $15 billion that they'll need to buy it already. So the banks have.
Broadening out for a second, what is steel demand like right now, globally and in the U.S., and how are prices? Because if you want to find one ticker for steel prices, good luck. It is such a regional market. Give me the landscape.
No, steel prices are, what we had was kind of an interesting year. Usually you have steel prices at the beginning of the year increase because of seasonality. Obviously, construction's the biggest market. Summer, it's easier to do construction. Everybody's buying steel. What happened is that auto workers strike last year, Everybody held off buying steel because they thought steel prices would really go down because the auto worker strike was rumored to be prolonged. And really what happened is the auto worker strike didn't have as much effect as people thought. Everybody rushed back to the market and really pulled in pricing at the end of last year. So you had kind of that peak of pricing rather than coming in the first quarter. Actually, prices peaked back at the end of January. It looks like now they're probably hit a bottom. Both Nucor and Cliffs have come out with announcements that, you know, $825 a ton we want and $840 respectively. So that's kind of stopped the free fall in prices. You have a lot of uncertainty. What I would characterize across the world is hand-to-mouth buying. You're just buying what you need. You're not taking any speculative risk or anything like that to build up inventories.
All right, Richard, thanks a lot. We super appreciate it. Richard Berg, Bloomberg Intelligence Senior Analyst on U.S. Steel. Some breaking news for you. SpaceX has lost Starship during its re-entry, cutting its mission short. SpaceX launched its colossal Starship rocket on its third major test flight. They're hoping to improve past attempts that also ended prematurely in explosions. And it looks like now it loses its Starship during re-entry, cutting that mission short. We will bring you any headlines as they cross and update you on the story. Let's go to Michael Barr with World and National News.
Thank you very much, Alex, Jen, and John. And as you just mentioned, and that SpaceX, they're cutting it short now because they lost the Starship. Now, they launched it. It looked successful. It was the third major test flight after two past attempts ended prematurely in explosions.
T-minus 10, 9, 8, 7, 6, 5, 4, 3, 2, 1.
The spacecraft stacked atop its super heavy booster lifted off about 2 hours ago from SpaceX's Starbase launch site in Boca Chica, Texas. The Starship is the biggest and most powerful rocket ever built. We get more from Bloomberg's Ed Ludlow.
Starship can carry more stuff. That means that they can build out the Starlink constellation more quickly. That generates higher degrees of revenue. It gets them to more sort of solid ground on cash flow break even, and that funds the bigger picture goal for Starship, which is to carry humans to Mars in the long term, but in the short term to the moon in the first instance.
Bloomberg's Ed Ludlow. The head of NATO says member countries must boost their military aid to Ukraine as Kyiv's forces struggle to hold the line against a fresh Russian advance. NATO Secretary General Jens Stoltenberg in Brussels today says Ukrainians are not running out of courage, they're running out of ammunition.
Together, we have the capacity to provide Ukraine what it needs. Now we need to show the political will to do so.
Donald Trump is at a federal courthouse in Florida. The judge will hear arguments on whether to dismiss the criminal case accusing the former president of hoarding classified documents at his Mar-a-Lago estate. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg News. And with this Bloomberg Business Flash, we're keeping on top of the story that Alex mentioned with the SpaceX losing the Starship during re-entry. Mixed economic reports today signaling the Federal Reserve may still cut interest rates this year, but later than thought. Right now, we have the major indexes in the red, but it looks like the NASDAQ is going to turn green here any moment. The Producer Price Index did rise the most in 6 months. 8 of the 11 major industry groups in the S&P 500 lower right now. You have real estate and utilities. That's proving to be the biggest drag. Lennar, the worst performing stock in the S&P 500. That's down 4.5%. The home builder reporting revenue for the first quarter missing the average analyst estimate. Meantime, Mark Lashini at Janney Montgomery Scott says, you know what? Mega cap tech stocks are overbought, and he is now looking to energy shares.
Net, with a decent economy here domestically and some improvement we're starting to see emerging globally, to me, that is the ingredient for why oil prices are being propped up and could even continue to grind higher. And so, obviously, a profitable scenario for an energy patch that has been a laggard.
And right now, energy is the best performing industry group in the S&P 500. Among some of the individual stocks on the move as well, Dick's Sporting Goods reporting sales that surpassed expectations, spurred by strong demand for sports gear. Dick's right now 13% higher. Overall, S&P 500 down 12 points. That's a decline of 0.25%. The Dow Jones Industrial Average is down 51 points. And the NASDAQ 100, 24 points lower right now. That's down about 0.1%. That's been fluctuating. 2-year yield of 4 basis points. The 10-year, 8 basis points higher. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Jen and Alex.
Thank you so much, John Tucker. I'm Alex Steele here with Jen Ryan. Paul Sweeney is off for the week. We are live from Interactive Broker Studio right here in New York, in Midtown, where we cover all the top stories for you with our great analyst over at Bloomberg Intelligence. We cover 2,000 companies and 130 industries worldwide. So here was something that caught everyone's attention. Blackstone President John Gray was in Rome, tough gig, attending the Bank of America Global Investor Summit Conference. And here was the headline: "Time to buy real estate as prices are at bottom." He says, quote, "The perception's so negative, and yet the value decline has occurred. So when you get into this bottoming period, that's when you want to move." Let's get another perspective here. Lisa Nee is managing partner and head of real estate over at Eisner Amper. She joins us here in the studio. Is that true? I mean, who's going to disagree with John Gray? Like, clearly talking your book for Blackstone, too. But prices bottom, time to buy.
Well, first of all, thank you for having me. So his perspective is correct. And so what happened when Signature Bank went out and brought its portfolio out to market, the prices were at a really good rate for people to come in and take the opportunities and go purchase all those great assets that were in that portfolio. And so he was one of the companies that went out and was looking at those portfolios. So there is plenty of opportunities for that careful investor to go out. And there is capital to go out there, whether you're saying it's a distressed asset or a really good investment. The market is set, whichever sector it is. So never going to disagree with him. He certainly is accurate on that one. And again, it's for that investor who's making sure that they're really doing their due diligence and their background, making sure that the interest rates and the cash flows make sense. That's always first and foremost.
I mean, I, for one, definitely would not want to disagree with him. But one question I would have is, the whole reason why we're in this commercial real estate crisis is because of the shift to working from home. And so is that crisis over? I mean, it still seems to me that, you know, personal anecdote only, but the subway isn't nearly as full as it used to be, even though it's picked up a little bit. I mean, if people are still working from home, there's still quite a lot of risk there for somebody trying to get in at these low prices.
Yeah, so real estate is cyclical. So every asset class goes through its highs and lows. It was retail, now we're at the lows of office. We're gonna see some inflections and some differentiation within multifamily as well. And when we look at what work from home concept did, I'm looking around here today and I'm seeing a great amount of activity where people are collaboration. And if you look back, I think 2 or 3 years ago, all the big tech companies said everyone gets to work from home, and they've changed their statements. They're coming and saying, we want you back 2 to 3 days a week. And when you look at an office lease, you were leasing office space for 5 days, but you were getting it for 7. And so it's just changing how you're looking at office, and in looking at some of the buildings that are out there in the marketplace, those older buildings that need some adaptive reuse, we're going to need that regardless of where we were in the cycle.
Yeah, and you think there's people out here now, you just wait till the snacks come up around 2. It's like people wait online for that stuff. So to that point, just in terms of the capital being out there, do you notice the bid ask? Like, have we resolved for that gap yet, or is that still to come?
So that it hasn't been resolved, and what's happening is because of the banks and their underwriting and regulations, they're unable to go in and provide a capital at a rate that's worthy of what what's being underwritten. So who's coming in? The rescue capital, which is people who are opportunistic. So you're going to come in as a preferred equity or a mezz lender, or even at a higher rate, and so those interest rates, if you're that really discerned investor, is going to be very good for you, but it's not going to be great for the owners, and they're not going to get their cash flow back. So the rates right now for the rescue is really, really high. So we're not at that point.
On average?
We've seen some preferred equity coming in between 18 and 20%. That's very. Remember, those are for some distressed deals that might need that rescuing, and they just don't want to give back the properties.
What's it going to take to broaden this out beyond non-rescue deals?
What's it going to take? So we have to wait to see, as you mentioned before, what the feds are going to be doing later in the year, where interest rates are going to be, who's going to be providing that capital? Is it going to be the banks getting back into the market? So if the banks go back in and they're at a better point where we can pencil out some deals, it could just be a wait and see approach. Also, there's not a lot of trading going on, so people really don't have the true understanding what valuations are right now. So time's going to tell, and we really don't know where we're going to end up in the long term, because consumer behavior is still so different than anyone has anticipated in the past.
So let's broaden out then and talk about, say, reshoring, onshoring, nearshoring, all that stuff, and logistics. We were supposed to see like a ton of data centers built, a ton of logistics, and then a ton of factories built. Are we still seeing all of those 3 things happen?
So I love the fact that you brought up the concept nearshoring, which is now Canada and Mexico really is coming in. So it's going to really change the landscape of where those industry and those warehouses were being built. Before, they were built on the east and west coast. Now you're going to see them having to be built northern and southern, because that's where the cheaper containers are going to be able to be brought in. Because so Mexico, which was our largest importer, exporter this year, and Canada coming in. So it's going to change where those industrial cities have been historically in the U.S., and it's going to change the landscape. So once you change the north and the south with the industries, you're also, for an industrial center, multifamily is going to change. Commercial office centers are going to change there. So to really look at where we are in the region and those cycles could be really interesting when you're looking at the concept of nearshoring versus right-shoring.
It's interesting. Can we shift gears a little bit to talk to about a subject very near to my heart, which is residential real estate?
Oh, yes. We always go there. We always go there.
Why don't you just take out an ad, looking?
She's
you're
in the
looking
market.
to buy.
She's looking to buy.
Okay.
It's not the best process.
I might have a house.
Help me out. John's got a house, some long houses.
Supplies coming online.
It
Okay.
ain't cheap, though.
There you go.
So what's the outlook? What am I looking for here?
So I think you have it spot on. Is so the people who have the homes would be looking to go. We have no place to go to sell, and so for us to replace our homes there's no place for us to go at a low cost of capital, and so that's why that housing market is so difficult, and why pricing is still so high for residential for single family homes. And if you look and you look at Biden's bill that he's proposing out there when he's talking about housing, they are very well aware that we do not have enough supply for the demand of single-family homes. And so you are not alone with your frustrations, but for people who could be potential buyers, we're sitting and waiting because we don't know where our next home is going to be, and that's not helping your story at all. So I'm
getting no love on
feels
the
your
show
pain.
this morning.
She feels your pain on that.
And at 325, I think we're staying put, really.
We can't replace it. That's really what.
My mortgage is higher. No, my toll bills are higher than my
Yeah,
mortgage.
but that's a
right now.
reflection of how you feel about your toll bills.
No, it's true though.
No, I know it's true, but I also feel like you like to complain about toll bills, which is
I
fair.
like to complain about everything.
That's also fair. All right, Lisa, thanks a lot. Really great stuff. Definitely come back. Love that conversation. Lisa, new managing partner and head of real estate over at Eisner Amper. But yeah, John Tucker and I are your problems at the end of the day. I mean, with our low mortgage. Like, he's trying to be cool with the 3 handle on his mortgage rate, but what else? I got it too. But it's cool. It's cool. It's cool. We're coming up. This is Bloomberg.
Your company news headlines on Bloomberg Radio.
And I'm John Tucker in the newsroom. We'll look at some of the company stories we're following. Let's start off with Walmart. They're looking to sell software that helps other companies deliver goods more quickly and efficiently. It's all part of their effort to broaden their business activities beyond just selling stuff and groceries. The company offering the software after building the services out and using it internally over the past 2.5 years. Now, Walmart says this has helped to save $90 million just in 1 year. The software uses artificial intelligence to map more efficient routes for their trucks, making deliveries to stores to help orders arrive in time. The Body Shop hit with a proposed class action on behalf of hundreds of employees who were abruptly terminated as the cosmetics retailer collapsed into bankruptcy. So the fired workers filed their complaint just days after the eco-friendly products chain filed for Chapter 7 bankruptcy in New York to liquidate their U.S. operations. The plaintiffs were employees at a body shop in Brooklyn. They contend the sudden terminations violate federal and state notification requirements. And things are getting smaller at Google. It's not just the headcount. The company accelerating changes within its lavish corporate cafeterias from offering
Today, I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
Well, I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
But it's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
From the UK, and I'm the inventor of the gel razor. And today I'm looking for an angel investor to fund my project, the gel razor, whether that's a working concept and working prototype, or manufacturing possibilities with investment, or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I did that all in one. The idea is you pressurise the handle. The gel flows through the reservoir up to the head of the razor, coating the blade, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
Well, the analysis from a research company in Longboat Key, Florida says this shortage cost the economy about $33 billion in 2022. Wow. And they project that the country will be short about 550,000 plumbers by 2027. So the next time you're calling a plumber and it takes forever to get an appointment and then it costs you a fortune, this is why.
You know what's interesting too, totally anecdotal. So when we moved into our apartment, it was a gut reno. We didn't do it, someone else did it. So we have all that fancy new stuff, like a floating toilet, floating sinks and things. And I had a plumber, regular dude, like come in to fix a shower head. And he's like, I don't know how to fix all this new stuff. Like, this is not the stuff that I'm used to fixing. And now you have to like break down a wall to fix a toilet. And he's like kind of out of his element. And I thought that was really interesting. It's like a whole new world with all the fancy stuff.
Note to self, don't do a fancy reno when I finally get an apartment.
No, we totally were. I mean, we didn't do the reno, but oh my God. I mean, like to fix a sink is like a Herculean task.
Maybe I'll just keep it a closet then.
Hey, there you
You're
go.
starting to scare
Just
me.
don't be fancy. I think the takeaway is it's not good for the economy.
think I'm
It's not
fancy?
good for plumbers. It's not good for pricing. This is our takeaway.
Exactly. I mean,
Love the story.
It is a great story, and there's a lot of great anecdotes in there. Some people who cite this very
This
issue.
is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Thursday, happy Friday Eve. We are so close to that weekend. Markets under a little bit of pressure here. Yields up as well. Coming up in the next hour, we're going to have all things tech for you. We're going to talk about TikTok and what happens there with Dan Ives over at Wedbush. We're going to talk about Tesla. That stock still down by about 3%. We're going to talk to Steve Mann, Global Autos Industrial Research Analyst at Bloomberg Intelligence. We got you covered on all fronts. Let's get you covered now with Business Flash. Here's John Tucker.
All right, Alex, Wall Street digesting signs of sticky inflation that could keep interest rates higher for longer. You mentioned Tesla there. That's lower after a UBS analyst cut the price target on the stock. Among the most actively traded right now, down 2.5%. NVIDIA edging lower with a key conference in focus, and that's also dragging some of the other chip makers down with it. You have NVIDIA right now down 2.5%. Advanced Micro Devices, among the most actively traded stocks, that is down 0.4%. But meantime, optimism not necessarily fading. Russ Kostrich at BlackRock says, as far as investors are concerned, the Fed is pretty much taking a back seat to some of the market fundamentals.
Long-term yields have been relatively contained. The economy is still solid. We're likely to get 2.5% real growth, 4.5% to 5% nominal growth. That's a good background for earnings. And this is why I think the market is continuing to move forward, even as investors have repriced these Fed cuts.
All right, as he speaks, the NASDAQ 100 turns green, up 2 points right now at 18,070. S&P 500 shedding some of the earlier losses. It's down 8 points right now. That's down just about 0.2%, 51.56 on the index. Same for the Dow, 46 points lower right now, and that is down 0.1%, 38,997 on the index. The benchmark 10-year yield, as you mentioned earlier, 9 basis points higher. I have it at 428. The 2 up 4 basis points. That is at 468. Get a bunch of stuff tomorrow, Friday. UMich Consumer Sentiment Index, industrial production, and the data is going to set the stage for, of course, next week's FOMC meeting. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Jen and Alex.
Well, speaking of, Fed swaps now price in less than 75 basis points of easing in 2024, Jen. Interesting. I wonder if that means overall the cutting cycle will be less, or just this year it may be a little less.
I don't know, but what I will say is I'm very wary of any takeaway this week because we're all just waiting for the Fed, and it's not a very heavy data week. They're in a blackout period.
That's right, and also maybe get changes to the dots. Now the dot plot matters again, and that's what we're kind of looking at. So let's get an update here on the market. Abigail Doolittle is joining us as we see stocks under pressure. Actually, I can't even say that anymore because the Nasdaq is trying to make a run for it, and S&P's only down 1/10. What is up?
Yeah, we have some volatility here. Now, it's not on a lot of volume, and something I would say, speaking of volatility, options expiration is tomorrow, and Steve Sosnick of Interactive Brokers was telling me yesterday, he's going to be joining us tomorrow for Options Insight, that NVIDIA expiration could be somewhat wild, so maybe a little bit of volatility ahead of that. It's interesting to me that, so when CPI came in a little bit warmer, I wasn't too surprised that stocks didn't sell off because it was just so slight, and it still really kept the idea that 2024 is going to be a year of cuts. The PPI is just a little bit hotter here and maybe introduces to what you all were just talking about. You know, at one point at the end of last year, I think traders were pricing in 6 or 7 cuts, and then they had to meet the Fed at 3 cuts. And then after one of the data points, I think last week or 2 weeks ago, it went back up to 4, and now it's slightly below 3. So traders are really kind of getting whipsawed. I would say every time that we see some of these moves, even if they're smaller or bigger on an intraday basis, mini repricings of risk, if you will.
I wonder if we could go back to some of the other data that we saw this morning, which is the retail sales numbers, because I would love very much to get your take on what consumer stocks are doing right here. I see consumer discretionary and consumer staples are both down, but less than 1%. And I wanted, if you think like that's an appropriate move, or were you expecting a little bit more there?
So I actually don't think that too, and I don't think that the moves that we're seeing in consumer staples, at least, let's start off there, reflects retail sales too much. There was an interesting story earlier that we have Altria buying AB InBev, or excuse me, I just scrap that. That is literally not at all. I'm not sure where that came from. We have Altria selling some of its stake in AB InBev. So Altria is one of the top stocks in that index. Most of the other ones are lower, and you have some of the competitors to Budweiser down as well. But I think you just have some general selling there. Does that reflect the retail sales? I don't think so too much. I don't know. I mean, what do you guys think about that?
I mean, it just feels like we're just repositioning a little bit.
Yeah,
right?
that's what I think so too.
We had a couple days where you had the Russell able to outperform again, and now we're just sort of back to the Monday narrative a little bit, where tech is trading a little heavy, and I put that in quotes because, like, who really knows? But I am interested, like, at what point do higher yields hurt the equity market?
I think that's a great question.
I'm puzzled. I'm perplexed.
Well, I think that, and we've seen this before, but at lower levels. We've been at these yields before. Stocks digested them before. The question is, when are higher rising yields going to pressure stocks? I suspect that it could really be a 5% number on the 2-year yield if we get there. 450 on the 10-year yield, some of the psychological levels. And even though we've been at both of those levels before, I think just going back above them in the psychological, I think that would probably wake up some traders to the idea, okay, you know, inflation's not going away right away, yields higher for longer. I think that's when we could see it.
In that kind of a situation, is there any part of the curve that you prefer, or any area in the equities market that you'd prefer?
So if we go higher, I would say in terms of bonds, I can't really speak to preferring certain areas of the curve or not. I could talk more to where I think yields might go based on the chart technicals, because they chart very well. In terms of stocks, you know, I think that's going to be, if the 2-year yield goes back above 5%, I think that's going to be a situation where a lowering tide probably takes down all boats. I think it might take down technology more, something like NVIDIA even more, that was up 800% in such a short period of time. Some of the other big tech names that have gone up so much. But I think that it would be a defensive posturing overall.
Mm-hmm. Yeah, it's tricky. Next week is going to be interesting.
Yeah, now it's interesting with this PPI number. I would agree. And
right?
retail, I mean, the tension between the PPI and the retail sales. I mean, do they even negate each other in some ways relative to the Fed?
Well, also what we saw is that for the PPI, the companies are taking a little bit of a hit. Like, they're not passing all of that on to consumers, so then they're getting hit on their margins. So then that's maybe what small cap thing. Anyway, now I'm much more interested in next week. All right, Abigail, thanks a lot. I really appreciate that. Let's go now to Tesla. So that stock is down by another 3%. Let me just see if I can pull up how bad it's been for Tesla, because I got to say it has not been very good. The news from yesterday, of course, is Wells Fargo, Colin Langan, says there'll be zero growth in sales volume for the EV maker this year. So can you be a company that's growth company if you have no growth in sales? And that stock has just really had a tough run of it, down 18% just so far this month. Steve Mann is Global Autos and Industrials Research Analyst. He's standing by for us. Steve, what do you think? Growth company with no growth?
Oh, I tend to be more optimistic about the company. I really like the stuff they're doing behind the scenes with AI, with full self-driving, the Optimus robot. I think the company is pretty much set up, vertically integrated, to actually succeed. So I'm not as negative, but there is a valley, right, that the company's going through right now. The problem is, you know, where is the bottom of that valley? Because prices for their cars just keeps coming down.
You know, one of the issues that Elon Musk has faced with Tesla is what he gets out of cutting prices. And I wondered if you could talk a little bit about what you think he's going to be able to earn if he thinks that he's going to be able to institute more, if he thinks he's going to be able to get more sales with lowering prices.
Yeah, I think so. I mean, the pricing is pretty elastic. I think he will get some sales. The question is how far and how much price cutting can he do from now on? Well, their gross margins are still in the mid-teens. They still have room. I think relative to the legacy automakers, their margins are still relatively healthy. The issue is China. China's a hyper-competitive market. Their main rival is BYD. They're continuing to cut prices. And if they do cut prices in China, they really have to do the same elsewhere in the world to eliminate the arbitrage that can actually occur if there's a price difference across the world.
So here's my question. I hear that it's not as desperate as maybe Wells Fargo was saying, but we're still looking at an estimated price to earnings multiple of 54 times. So is it worth that much based on everything we've just talked about? Do we need to re-rate that in a more significant way?
We do. I think we're in a cycle where we're going to see some re-rating. But long term, I'm really excited about is the company is actually very vertically integrated. They're actually behaving like an Apple, where they're trying to create an ecosystem. We haven't seen it yet, but it's an interesting thing. They're doing a lot of interesting things with manufacturing, with their FSD, and how it creates value for the long-term owners of the vehicle over time. And that's, I don't think the market wants to look at that right now, given the slowdown in EV sales. But again, like I said earlier, we're in that valley, and there is, I think, light at the end of the tunnel. But where are we at? Are we at the bottom of the valley? That's the main question. I don't think we're there yet.
I want to pick up on your point, that we don't think that we're there yet, because I feel like there might be more to come from analysts, potentially more people souring on Tesla. But do you agree on that, or what's your expectation for the coming quarter?
I do. If you look at consensus earning, the range is very wide. I think there's still very bullish people out there, bullish analysts out there. That's going to have to bring down earnings to a little bit more realistic to the current growth rate that we're seeing, especially in the U.S. market.
When do you think we then get to the valley, and what does the valley look like?
I think one thing that we have to keep track of, and that's what we're doing as well, is a slowdown in price cuts. We may be starting to see that at the moment because price cutting, the additional sales from price cutting is actually shrinking. That gap is shrinking. So I do see we're closer to that than maybe 6 months ago. So hopefully, by mid-year, second half of the year, we can see some relief in price cutting.
Talk a little bit about Tesla's margins, because we've got some analysis that says that Tesla aims to slash production costs by about 50%, but maybe that's going to wind up being more about 33%. What do you think about that?
Yeah, I think their target of 50% is a stretch target, especially as they ramp up the Model 2. This is the 50% that they're referring to in cost cutting is really on their next generation of vehicles, the Model 2. And they've done a huge, significant, revolutionary change to how they build vehicles. You haven't seen that since Toyota introduced the lean manufacturing in the 1950s. So the price cutting of 50%, likely unrealistic, especially as they ramp up production in 2025 and 2026. Maybe beyond 2026, we may get to 50%, but that's a little bit far out there to really forecast.
So, Steve, I was interested in what you said about Apple in terms of sort of being all things to all people in one area, right? So
Yes.
Does that mean, and I know that Apple is a hardware company, but they really want to be a services company. They want that to take up a lot of their space in terms of earnings and their revenue, right? Makes sense.
Right.
Do you think that Tesla's going to do the same thing? They're going to get, your solar panel, and they're going to get services from that. And I appreciate that Tesla's a little bit different. And your battery storage, and then your car. Is that the company it's going to be in 20 years?
If you look at all the things that they do, right? The solar panel you just mentioned, the Starlink satellite system, those all can be connected where, I can imagine where Tesla, not only, you have the Uber or Lyft model, that, robotaxi model, but, these cars are actually carrying heavy, high-capacity batteries that, it can be moved around, redistribute power around, and you have the Starlink system really connected to these vehicles to really manage that in a more efficient way. So, we haven't really talked about energy. We only, I think the market really are focused on the current EV sales and how are they going to roll out the full self-driving. But the, long term, the next step could be, managing power with these mobile batteries that are in these cars.
Can you talk a little bit more about demand for electric vehicles? And part of the thing I'm wondering about is if you see that Tesla is going to need a very particular policy environment in order to see sales continuing to pick up. And, in particular, we've got the election coming up, a potential change of administration. Is there anything to think about there for what that would mean for Tesla?
Actually, I think Tesla have a unique benefit where they're actually a very global company already. Like, they have a third of sales in the US, third in Asia, mostly China, and then third in Europe. So they're very diversified regionally. So I don't think they really need any specific policy push from the US. With their Model 2, their next-gen vehicle coming out in 2025 and 2026, that will really resonate to a lot of the emerging markets around the world. So US is an important market, but I think their aim is really to go even more global.
Hybrids. Is hybrids going to be a consistent thorn in Tesla's side, or do we think we overcome that?
I think the world's going to see a mix of powertrain to really get to kind of net zero emissions. So I think in the US, I think, plug-in hybrids will play a bigger role, potentially bigger role. But I think the rest of the world, we're going to see, significant growth in Southeast Asia, continued growth in China. Europe, you're kind of between the US and Asia. I think there's still a big enough space, a big enough market. I think the pie for battery electric vehicles will continue to grow and absorb some of the newer competition that we're seeing from that Tesla is facing.
All right, Steve, we're going to leave it there. Steve Mann, Bloomberg Intelligence automotive analyst, joining us. Really good stuff. Okay, so I know you're in the market to buy a home, but what would it take for you to buy a Tesla or an EV? High bar?
I think the charging situation is just too horrible. Like, there's just not enough around anywhere in New York City. Well, no, I take that back. There's a lot in Manhattan, but you get to the outer boroughs and it gets a lot more tricky.
There is a lot coming up in Brooklyn. Like, you can see dedicated charging spots, but I'm also in Park Slope, so that would make a lot more sense. But I wonder, too, is that we put so much emphasis on the EVs and we missed the hybrid there. And I feel like we're all playing a little bit of catch up, because you can make an argument that while John Tucker waits for his hydrogen car, that, a hybrid makes good sense.
Yeah, I'm not disagreeing with you. I just don't have any money. So I'm spending so much on my bathroom.
Oh, yeah. Well, you've got to pick your poison, don't you?
That's true. One big purchase, you're doing the house, you're doing the bathroom.
It's an environmentally friendly bathroom.
What? It's gonna be really tough to get that fixed.
Yeah.
That's true. No floating toilets, no floating sinks. I'm really glad we worked that out. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with his Bloomberg Business Flash, being brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with the solutions they need to grow a thriving business. Commonwealth, go where you grow. Visit commonwealth.com to learn more. Earlier declines in the major averages starting to evaporate somewhat. A big part of this is Microsoft. Microsoft on track for a record high close. Best performer right now, the S&P 500, the Dow, and the NASDAQ. The stock has risen, 10% this year as of the last close. It's climbed 59% in the last 12 months. And, of course, it has the top weighting in the S&P 500 and the NASDAQ, and the second biggest weighting in the Dow. So it's a mover. The reasons why it's up, the company said it would make its artificial intelligence product Copilot for security available worldwide next month. So this seems to be the latest bid to roll out its AI products to more enterprise consumers. Walt Disney shares, they're down 2%. Worst performing stock in the Dow. Disney making a stronger push to find somebody to replace CEO Bob Iger when he retires. Disney's board focusing on 4 divisional heads. Overall, the S&P 500, 16 points lower right now. That's down 0.3%, 5149 on the index. The Dow Jones Industrial Average, 87 points lower. And the NASDAQ 100, it was up earlier, right now down 35 points. That's a decline of 0.2%. Let me check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Jen and Alex.
All right, John Tucker, thank you very much. I'm Alex Steele with Jen Ryan. Paul Sweeney is off this week. We are live in our Interactive Broker studio. You are listening to the Bloomberg Intelligence Radio Show. We have our awesome analysts that cover 2,000 companies and 130 industries worldwide. But now we turn to another expert in so many fields, and that is Jason Kelly, which apparently you're chief correspondent now at Bloomberg Originals. I didn't know that was a title. I guess I missed that.
Yeah, come on, keep up.
Jason's literally had every job that there is to have at Bloomberg, and he's done an amazing work. But what he's doing now is he's launching, this is the 3rd episode of The Deal with Alex Rodriguez and Jason Kelly. It is basically business of sports in a big time way. What's the 3rd episode about?
So the 3rd episode is a really fascinating one. It is not a headliner in the traditional sense. It's a woman named Constance Schwartz-Marini. She has been a business partner to Michael Strahan, Snoop Dogg, Erin Andrews, and Deion Sanders, among others. She is this empire builder for athletes, entertainers, celebrities, off the field, off camera, what have you, and has just built this amazing business. She saw something when she was working at the NFL in the early 90s that there was this massive opportunity given how much sports carries cultural and social relevance, and we've seen a lot of that. Even you, Alex Steele.
Tell me.
Well, ever heard of Travis Kelce and Taylor Swift?
Yeah, I have a 9-year-old.
Yeah, you have.
We listen to a lot of Tay-Tay.
So one of the most interesting things that's happened for Constance and her business over the past few months is Taylor showed up at a game wearing a top and then a jacket designed by Wear by Erin Andrews, which is Erin Andrews' clothing line. And not shockingly, that item sold out within minutes once it flashed for 6 seconds on the screen. People just started Googling. And Constance tells this great story on the show, on the podcast and the show, about them essentially seeing it and then madly texting each other and calling each other like, we think that's it. Is that ours? Is it?
Oh, so they didn't plant it.
They didn't.
No.
They had sent, Erin Andrews very smartly had sent Taylor some stuff, but you don't know if she's going to wear it. And then there it was.
I love that we now know that
Yes.
was not necessarily planned, because that just changes it all.
Yeah.
Doesn't it? I think that's fantastic. So look, this is such a fascinating business area, and I wondered if you could just give us a bigger sense about how she's doing on this.
Yeah.
What are some of her big deals?
Yeah, so one of the interesting things that happened with her is, so she identified Michael Strahan as someone who had this potential beyond being a Super Bowl winning football player. And one of the great stories that she tells is that when Michael Strahan was inducted into the National Football Hall of Fame. They had a ceremony at a New York Giants game, and Constance was standing on the sideline with a friend of hers and a friend's daughter, sort of a, a Dylan situation.
Yeah.
And the daughter says, why is Michael from Kelly and Michael getting some award here? Like, and she knew, and people turned to Constance like, oh my God, is that really bad? And she said, no, that's amazing, because now this guy has like levitated into something much bigger than sports. He's a personality. And, you look at what Strahan is doing now, hosting Good Morning America. So that's sort of her handiwork. I mean, her biggest project of late has been Deion Sanders, Coach Prime. She was the one who really kind of navigated him into the coaching world, and not just into the coaching world, but into really leveraging his iconic status, whether it is sunglasses or, setting up deals for the players that he's recruiting to University of Colorado.
How does she pick it? Like, how does she know? Like, what's the thing? Because we talk about a lot, like, we're in media, right? Like, you have it or you don't, blah, blah, blah. But there's got to be something a little bit more scientific in how she approaches that.
That's a great question. I don't know how scientific it is. I think it's a lot of gut. I mean, I think it is understanding and watching people. And, one of the things that I've learned, from working with Alex and Alex Rodriguez, sorry.
For sure. I mean, he's also worked with me, but I'm definitely not as cool or as tall.
The second most important Alex in my life, Alex Rodriguez. But, these athletes, they're not all the same in terms of their ambition. And there are a lot of athletes and entertainers who they just want to go and play the game and do their thing. And then when they're done playing, they're going to go do something else. But for Alex Rodriguez, for Michael Strahan, especially the experience of playing in New York. Michael Strahan talked a lot about this, and Alex did too, really allows you to elevate and to be exposed to all these different things. One of the things Strahan told us was, there's no way he's where he is if he plays in Green Bay or in Houston. No shade to those places, but New York's New York, and you just get the opportunity to do these bigger and better things.
One question I have about this is, I look at your story, I hear what you're saying, and I think, I can't believe it's taken this long for somebody to think about how to think about a second act for these very important, high-profile people. But now that engine is going, how much further does it have to run?
I think it's interesting you asked that, Jen, because I think it's going to run even further. And one of the main things that's happening is, as you both know, high school and college athletes are now allowed to be paid for their name, image, and likeness. And so that has opened up an entirely different world. You actually saw Nick Saban, the legendary coach of the University of Alabama, step back. He retired. He was from coaching for 40 some odd years because the economics have changed so drastically. The reason it's changed so drastically is because these players can now get paid. They can become brands of their own at the age of 16, 18, 20 before they even go public, before they even go pro. And see, I think like a business person. But, that is an element that's really fascinating. You look at what's happening with Caitlin Clark at Iowa. I mean, that's remarkable, the amount of money that she's making as a college athlete, and candidly, as a female college athlete. That was unheard of a few years ago. So there's a ton of runway to go, in part because it's opening up to a much wider group of people.
What are some mistakes that she's made in this? Did she talk about like betting on something that just didn't work?
Well, I mean, I think that there are products that you put out into the world, and Strahan has talked a little bit about this, things that he got behind that, just didn't work out. You invest in one thing or you don't invest in something. One of the things that Strahan talks about is he was pitched Tinder very early, and he's like, I don't get it. Passed on that.
Thing.
Missed on that.
Swipe right or left?
Whatever. The swipe.
You're swiping.
You're doing some swiping. Alex Rodriguez famously talks on our show about missing Uber.
Oh.
Didn't see that one.
Oh, that hurts.
Tens of millions.
That is tough.
Yeah. Oof. That's a tough miss.
We can all. I guess he's lived though.
Everybody's okay.
Yeah.
Everyone's gonna be okay.
So is she gonna go, like, work with high school, college athletes too? Like, she isn't a good. I mean, because working with a 16-year-old, that's got to be tricky.
So it is a practice that they and others are undertaking. I mean, it's very. This is sort of the term that everybody uses. It's very wild, wild west when it comes to that stuff. And there's legislation probably coming on how that's all going to play out. So you actually do need someone who's very experienced in this, like a Constance and her team, to be able to kind of navigate through that for sure.
What's one of the biggest obstacles she finds in dealing with talent, getting them into the second act of their lives?
We are so complicated.
Yes,
We are
that's true.
so demanding.
Listen,
the talent is
yeah,
crazy.
Listen, I mean, diva, hello. I think part of it is, you know, being able to really apply those lessons of discipline, coachability, focus. It's all there, but you have to think differently. And also, operating in the business world, you can't just kind of do your thing and hope that everybody else, you know, a lot of these athletes operate in a world where it's like they've been the best and the most famous person at what they've been doing for their entire lives. Well, now they're like, if you're in business, like, you got to show up to the meeting, you got to follow up, and you got to keep doing it. And so I think that shift in mindset is often one of the biggest challenges for these guys.
Do you have any feedback for you about your Big Apple Circus outfit, or that didn't really come up?
No, it didn't come up.
To be fair, Jason Kelly played the, what is it?
Ringmaster.
Ringmaster,
yeah.
In this amazing pink sequin jacket and top hat. I mean, you should have seen me laugh so hard. My daughter's like, what's wrong with you, Mommy? Jason Kelly, wonderful to see you. Bloomberg Originals chief correspondent. You can check out the new podcast and video series, The Deal, co-hosted by Yankees legend Alex Rodriguez and Bloomberg's Jason Kelly. Download and subscribe to the show on Apple, Spotify, and anywhere you get your podcasts. Let's go to Michael Barr for the news.
Thank you very much, Alex, Jen, and John. SpaceX launched its colossal Starship rocket to near orbit in space before it was lost while returning to Earth. It started out successfully this morning. SpaceX carried out the third test launch of Starship, the world's most powerful rocket, and the launch was clean. 3, 2, 1. About 2 hours later, a live stream of the flight showed the craft re-entering Earth's atmosphere before the company lost data from the vehicle. Bloomberg's Ed Ludlow says Elon Musk's private space company will chalk this up as a success.
The payload in this case is not a satellite, it is not a human being, it's the data that the Starship system is generating and feeding back to SpaceX. The fact that they were able to launch the combined system, the booster and the spacecraft, get it to the orbital height that they did, the altitude they did. They had a successful hot separation in that process. Starship traveled on its telemetry over to the Indian Ocean, and then it started to re-enter Earth's atmosphere. The camera feed was maintained because of the onboard Starlink, and the signal was lost at 65 kilometers altitude.
Bloomberg's Ed Ludlow. The Starship is vital to NASA's plans for landing astronauts on the moon and SpaceX CEO Elon Musk's hopes of eventually colonizing Mars. Former President Donald Trump is back in a Florida courtroom this morning. His attorneys are trying to get his federal classified documents case tossed out. Trump claims that as president, he had the right to deem these documents that were found at Mar-a-Lago as his personal records. The special counsel contends they're classified documents. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with his Bloomberg Business Flash. Well, hot inflation reports reinforcing bets that the Federal Reserve is going to be in no rush to cut interest rates. You have Treasury yields higher, the major stock averages lower, at least for now. Gains in the shares of Microsoft right now, keeping a lid on further losses in the major averages. Microsoft, in fact, on track for a record. They're making their artificial intelligence product, Copilot for Security, available worldwide next month. And as the Fed policymakers prepare to meet next week, Julia Coronado at Macro Policy Perspectives says they can take their time before cutting interest rates.
3 rate cuts, they could start in June, July, and they'll have more data in hand by then. They are not in a rush, and I think that's the holding pattern idea. They haven't gained more confidence. They haven't necessarily lost confidence.
And among the stocks standout today, Dick's Sporting Goods climbing right now 13%. And let's say the retailers better than expected quarterly results and a potentially conservative guidance show consumer demand remains there for their stuff. Right now, the S&P 500 14 points lower. That's down 0.3%, 5150 on the index. And the Dow Jones Industrial Average down 96 points. The NASDAQ 100, 29 points lower. That is down just about 0.2%. And back to those yields, the 2-year is up 5 basis points. The yield up to 4.69. The 10-year, 9 basis points higher. Let's call it 10. Round it off. That's at 4.28. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Jen and Alex.
All right. Thank you so much, John Tucker. Let's turn now to TikTok. The latest, and this is quite interesting, Jen. Steve Mnuchin is apparently targeting a purchase of TikTok from its Chinese parent company. This comes a day after House lawmakers passed a bipartisan bill that would ban the widely popular social media app in the U.S. Quite interesting, particularly after he led that buyout of NYCB.
I know, and I think what's even more interesting about it is because there was that whole issue with NYCB earlier. It caused a lot of concern about regional banking. A lot of concern about TikTok on the minds of teenagers all across the country.
And politicians. So let's go to Dan Ives. He joins us, Managing Director and Senior Equity Analyst over at Wedbush Securities. He always has opinions about these things. Hey, Dan, I guess it's twofold. What do you think about Mnuchin leading a group of investors to buy TikTok? Let's just start there.
He's going to join the long list, right? I mean, others haven't talked, but if you look strategic, financial, you're going to have a long list of buyers from big tech as well as outside looking to get TikTok because it's a unique golden asset that no one ever thought would become available. We still believe only a 25% chance this ban actually happened.
So what's going to be the big sticking point for that kind of a bet? Is it the algorithm?
It's all about the algorithm. The source code is not going to lead. ByteDance in China are not going to allow the source code and the algorithm to go to a U.S. company. And that's buying an F1 car without the engine. That's the fundamental issue here is that because of the source code, it makes this extremely complex. The value is vastly different without the source code.
Mm-hmm. Well, then here's my question in terms of what the government will allow. It's like, will the government like a Mnuchin-led investor takeover? Will the government like a Netflix or a Meta or another social media company buying TikTok? Like, if you divest, like they have to be okay with who's going to buy it. What do you think?
The devil's in the details, right? I mean, the problem is, look, this is all a third rail issue. It's great theater in D.C. in front of the microphones. The reality is the selling and ban of TikTok, besides First Amendment, what could happen to other social media, there's a huge ripple effect, the negative retaliatory from China, as well as ultimately, how could you sell this without the source code? And ByteDance in Beijing are not going to allow source code to be sold. And that's the issue for Senate. I mean, does Schumer even let this get on the floor? That's going to be the problem. It's very good for grandstanding, but the reality of it is very complex.
Mm-hmm. I mean, and you add to that Congress really just has not done well in the past of turning denunciations of these perceived tech abuses into law. I mean, you think about things about like protecting children online, antitrust authority, data privacy. This is not something that has come into really forceful law. So, I mean, there's a chance this might just all fall apart anyway.
That's why it goes back. Like all the work we've done, 25% chance a ban actually happens. Because to Alex, like to your point, okay, so now a ban happens, the 25% chance. How do you sell it? So you're forcing them to sell. They don't have to sell without source code. Then who's going to buy it?
Mm-hmm.
And then it comes down to, okay, so now let's say it gets sold to Microsoft, to Oracle. Then is there antitrust issues from a government perspective? The problem is you can't put genie back in the bottle. This is going to have huge complications because TikTok, as well as the precedent, and even the spider web in terms of how it gets sold.
How much do you think TikTok's worth? Like, let's just game it out.
100 billion with the source code. Without the source code, 30 to 40 billion.
Wow. That is a big, 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 big difference. So what are you watching next for it then? Like, what's the next trigger point for you?
Well, I think now the soap opera, we'll see that in the 202 area code. Does it actually get to the Senate floor? What negotiations go behind the scenes? You have 150 million users. So, you're in election year too. So it goes back to that third rail issue, voting down TikTok as a ban, not good for the 18 to 24-year-old vote. So we got to see how this all plays out. Obviously, Trump on one side, Biden on the other in terms of the TikTok ban. Look, Mnuchin, that's the first shot across the bow in terms of, looking for, potential to line up as buyers. Others are clearly behind the scenes doing the same thing, but it's all a game of high-stakes poker right now, playing out.
So on the assumption that somehow this algorithm, the source code, does become part of the sale, who do you think is the best strategic fit for this as a buyer?
Look, there's a better chance of me playing in March Madness next week than this being sold with source code. And that's
Dude, you never know, man. They could come knocking on your door.
Never know.
Again, three-pointer, decent. But the point is, you never know in terms of now what Beijing and ByteDance are thinking. So now, even to just trajectory this out, let's say they do it without source code and there's buyers. The question is, where does it go? Is it big tech? Is it a consortium like a Mnuchin, other financial buyers? And this is going to be just a spiderweb of regulatory. It'll go through the court system. And I think that's how this is all going to play out. Is there's a huge ripple effect, unintended consequences when you go down this path.
Before I let you go, I got to ask Tesla. We talked about it earlier in the hour after that downgrade yesterday over at Wells Fargo, saying that it's a growth company with no growth. Correct? Accurate? Not accurate?
Look, for now, clearly going through massive headwinds in China, but we've never called Tesla for the last decade in terms of the next 30 days, 60 days. On the other side, growth is still going to be massive. EV leadership, AI, that's what we continue to be bullish here. But no doubt, it is a white knuckle period that we're going through especially in China for Tesla. And that's why bears are all coming out of hibernation mode.
Yeah, so what do you think is next for them in the next two quarters or so in terms of analysts coming out with dimmer views on it?
Yeah, clearly numbers are getting cut a lot. That's getting priced in. But it comes down to they got to lay out the goalposts. Are the price cuts done? We just came back from Asia. I think 95% of price cuts are done. If they put a line in the sand there, Street starts to look through second half of the year into next year, and I think then we sort of bottom out. It's also about Musk, the 25% ownership. I think at the shareholder meeting, they formally go to Texas from Delaware. That continues to also be an overhang over the stock. I think a lot of that gets resolved. We've been here before. I don't view this as really the end of the Tesla growth story.
Yeah, it's just sort of like delayed kind of thing. Hey, real quick, 20 seconds. NVIDIA headed into their GTC AI conference. What do you think?
The godfather of AI, Jensen, I think is going to show behind the curtains just what's coming. And because they're going to continue to lead the revolution. And this is not a 1999 moment. It's a 1995 moment. Get out the popcorn, parties are started.
That's why you love Dan Ives. He gives you those wonderful sound bites. Dan Ives over at Wedbush. We appreciate your time today. NVIDIA stock, though, off by about 3.5%. Overall market also trading a little heavy volume. still comes in light. This is Bloomberg.
Your company news headlines on Bloomberg Radio.
And I'm John Tucker in the newsroom. Look at some of the company stories we're following. You have top hedge funds and private equity firms, including Citadel, KKR, and Blackstone, discussing ways to blunt some of the penalties by the Securities and Exchange Commission stemming from their use of messaging apps. That's a no-no, with the regulator stepping up efforts to police Wall Street's electronic communications. The firms have held talks about how to design a legal strategy and what potential settlements could look like. Their goal is to minimize any fines and ensure if they do reach a settlement, no firm is singled out for harsher penalties. JP Morgan Chase, speaking of penalties, fined a total of $348 million by regulators over gaps in its trade surveillance program. It failed to monitor conduct of its employees and clients. The Office of the Controller of the Currency fined the bank $250 million. The Fed added another $98 million penalty. Both overseers required the bank to take corrective action to fix the issues, which they said were as recent as last year. Elon Musk's X took down a post its billionaire owner shared in response to a news report critical of how he and other pundits are politicizing lawlessness and violence in Haiti. The post violated X rules, according to a message that appeared from some users. Well, NBC News reported Wednesday Musk and influencers he interacts with on the social media service have been circulating unverified claims of cannibalism in Haiti. Well, you can watch movies on your TV. Now you can go to the movies to watch TV. Somebody's going to have to explain this to me. AMC has reached an agreement with NBC to show some of the network's live daytime coverage of this year's Olympics. So you could leave your living room to go to a movie theater to watch the Olympics. Anyway, that's your company news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
You're listening to Bloomberg Intelligence Radio. Happy Friday Eve. I'm Alex Steele along with Jen Ryan, who's in for Paul Sweeney. This is Bloomberg Intelligence Radio, where we get our top analysts to cover 2,000 companies, 130 industries all around the world. We give you all that insight right here from our headquarters in Midtown Manhattan. Let's also get you caught up with world and national news with Michael Barr. Michael?
Thank you very much, Alex, Jen, John. Senate Majority Leader Chuck Schumer took to the Senate floor today to deliver a scathing speech calling for new elections in Israel. Schumer believes Prime Minister Netanyahu's governing vision remains stuck in the past and will lead to Israel becoming an international pariah if he is allowed to continue with his operations inside Gaza.
As a lifelong supporter of Israel, it has become clear to me the Netanyahu coalition no longer fits the needs of Israel after October 7th.
Schumer also says Netanyahu has lost his way by allowing his political survival to take precedence over the best interests of Israel. Today, NATO is reacting after Russian President Vladimir Putin said that Moscow is ready for nuclear war if it came to it. U.S. Ambassador to NATO, Julianne Smith.
We take these threats seriously. We take the nuclear saber rattling very seriously. We monitor the situation on the ground. I will say at this point, we don't see an indication that Russians are preparing to use nuclear weapons. Therefore, the U.S. is not making any changes to its posture at this juncture.
Meanwhile, the NATO Secretary General has delivered his annual report on the state of the alliance. Jens Stoltenberg said NATO is as strong as ever, and he said member nations have supported Ukraine.
But Ukraine needs even more support, and they need it now. The Ukrainians are not running out of courage. They are running out of ammunition.
Donald Trump is at a federal courthouse in Florida where a judge is hearing arguments on whether to dismiss a criminal case accusing the former president of hoarding classified documents at his Mar-a-Lago estate after he left the White House. SpaceX launched its colossal Starship rocket to near orbit in space before it was lost while returning to Earth, a notable improvement after the first two missions ended quickly in explosions. Global news 24 hours a day and whenever you want it. With the Bloomberg News Now, I'm Michael Barr. This is Bloomberg. Alec, Jen, John?
It still feels like a ruh-roh, like when you can't find your spacecraft, right? Like, oops, yay, didn't explode, but that's still a ruh-roh.
Yeah, it was a little ruh-roh, but, you know, as long as it's not in my backyard, that's a good thing.
That's fair enough.
Yeah.
Jen Ryan here alongside beside me. We'll go with me. So here's a fun one. Justin Fox is a Bloomberg Opinion columnist. He covers everything, and he covers the fun stuff. So this Bloomberg Opinion column says older people don't want to work after the pandemic. So basically, you're looking at the mass departure, Jen, of 65 and older Americans from the labor force. And that has a big reverberations in the economy. Just look at the continued labor shortage.
It's really incredible. Justin is very, very good at crunching this Bureau of Labor Statistics data. And what he found is that putting all the numbers together, the rough estimate is that the departure of those over age 65 from the labor force has removed about 2 million people from the labor force. And that is out of a total of 165 million. And he says that dynamic seems to be the single biggest supply side cause of the labor market weirdness over the past couple of years.
I wonder, does it say, is it because of illness or death or just, I don't want to do these jobs anymore?
It's a combination of all of the above. And like we've talked so much about the difficulties in getting to the office, what you actually get out of a paycheck versus like saving the money for all that expenditure. So there's a lot figuring in there.
Okay, so my thing is, until my mortgage is paid off, I'm never retiring. So I have 27 more years to go. So maybe by the time I'm 80, I'll be able to retire.
It's just around the corner.
Like that. It's so close. I told my husband he's not retiring until our daughter gets out of college, and he's like, what? So he had to readjust those expectations as well. Really interesting article, guys. Definitely check it out on our Bloomberg Opinion columnist there, Justin Fox. Thank you so much. We appreciate you as well, Jen Ryan. Thank you for joining me for the hour. See you tomorrow. Coming up, Balance of Power with Joe Matthew. This is Bloomberg.
world of politics to the world of business. This is Balance of Power. Live from Washington, D.C.
Joe Biden goes blue collar to save the blue wall. Welcome to the fastest show in politics as the president heads back to Michigan today to make an appeal to union workers, young progressives. We'll talk about it with Bloomberg's Laura Davison here in Washington. And as the White House tries to slow Israel's offensive in Gaza, we have news from the Middle East that we'll talk about with Michael Allen at Beacon Global Strategies with insights from our panel, including Republican strategist, Bloomberg Politics contributor Rick Davis. He's joined today by Pat Dennis, Democratic analyst at American Bridge. We'll update you on the divest or ban TikTok bill today. Another delicate assignment as well for Kamala Harris. It's all after a look at Wall Street. Let's get up to speed on the markets first with Charlie Pellet. Hey, Charlie.
Hi, thank you very much, Joe Matthew. And here's what's going on. We have got the Dow, the S&P, NASDAQ, all in the red right now. 10-point drop on the S&P at 51.54. For the S&P, a decline right now of 0.2%. Dow Industrials dropping by 58 points, down 0.1%, while the NASDAQ Composite Index is down 22, a drop now of 0.1%. 10-year, 4.29%, with a 2-year, 4.69%. Gold down 0.8%, 21.57 the ounce on gold, and Bitcoin down 3.1%, 70,909 on Bitcoin. Crude oil up 1.8%, WTI now at 81.17 a barrel. A hot inflation report is reinforcing bets the Federal Reserve will be in no rush to cut rates, even as some areas of the economy show signs of sluggishness. Jay Bryson is chief economist at Wells Fargo Bank. He has been sifting through the data. He was interviewed this morning on surveillance.
You know, we need to step back and we need to say, okay, we all look at this data today, and what does this mean for the Fed next week? What does this mean for the Fed in May? You know, the Fed doesn't, at this point, it doesn't really know either. It's taking these data in its entirety as they come in, and it'll make its decisions as we go forward. And unfortunately, I think we're going to be in this choppiness, for a while.
Jay Bryson of Wells Fargo Bank. And among the economic reports out this morning, retail sales rose by less than forecast after a steep drop to start the year. Among retailers, Walmart down 0.3%, Target down 2%, Macy's up by 3.5%, Amazon up now by 1%. Again, recapping, stocks lower, S&P down 12, a drop right now of 0.2%. Balance of Power kicks off right now. As a matter of fact, back we go to Washington. Once again, here he is, Joe Matthew.
All right, Charlie Pellet, thank you. Welcome to the Thursday edition of Balance of Power here on Bloomberg Radio, on the satellite, and on YouTube. We invite you to join us on YouTube anytime during the day. Search Bloomberg Global News. You'll find our live stream. The cameras are lit, and we have a seat for you here in the studio. Welcome to Little Friday. We're almost there. Even as Joe Biden leaves the bubble, the Taoiseach is in town. It's 77 degrees here in Washington. And we're starting to get ready for spring. President Biden is getting ready for a campaign. He's in the throes of one right now, and going from Milwaukee to Michigan, where he's going to take part in a campaign event today, speaking, of course, to a constituency that he needs to win the White House. And that's where we start our conversation with Laura Davison, Bloomberg Politics reporter and editor, is with us here at the table. You're a vision of spring today. You clearly have seen the forecast. Great to see you.
Good to see you as well.
This is the time of year you want to be in Washington, right? Stage 4 cherry blossoms. We're going to talk about that later this hour. It's not part of the DEFCON scale. Joe Biden is going to go to Michigan today and try to talk to the unionized rank and file that tend to prefer Donald Trump. What message can he bring to them that he hasn't already after becoming the first president to walk a picket line?
I think what we saw really foreshadowed or last week in State of the Union is sort of this reframing of his messaging. He realized, okay, talking about, infrastructure, some of these things that take a long time, that are wonky, is not working. So he needs to talk more about the stakes of the election, talk about democracy, talk about freedoms. So he's talking about democracy, freedoms, he's talking about reproductive freedoms, and also talking about, what he would do looking forward when it comes to economic policy in terms of jobs, in terms of the statement he made this morning about Nippon Steel, Steel and how he wants to block that deal with U.S. Steel, which is going to, at least the White House hopes, resonate a lot with people in Michigan in these union states.
Yeah, I'm glad you mentioned that. It's not an accident that he's talking about this today, right? And we think we know who the audience is, to your point. The statement from Joe Biden, it is vital for it to remain an American steel company that is domestically owned and operated. Is he going to talk about this more stridently? How does the White House weigh in on this, knowing that actually they've had an allergy to mergers and acquisitions all along?
Yeah, I mean, so there's a lot of things that the White House can do. He have not yet said, if he's going to take some specific action to block this deal, or if it's more just, expressing discontent with the idea. So this is sort of the next beat on this of, will he, sign something or, pull some lever that would fully block this deal, which would probably play well in these states. We'll see what the polling looks like, but, looking at, he can tout, okay, look, I'm bringing in new jobs, I'm bringing in battery jobs, all of this, this green energy stuff. There's a lot of new plants popping up, including in places that are very red state or very red states or very red districts. So this can change the calculus for folks.
Interesting to see what Kamala Harris is up to today. I don't know if this ends up being a lead story later on. It seems significant to have the Vice President of the United States visiting an abortion clinic. She's going to the Twin Cities. Will be the first stop, as the White House is framing this, by a president or vice president to a clinic like this. These are pretty delicate optics in a story that already tends to favor this White House. What's the point?
So the White House has finally found its place for Kamala Harris, and that's to talk about reproductive rights and abortion and the fall of Roe v. Wade. You have a president who is very uncomfortable with the word abortion. In his prepared remarks for the State of the Union, it had abortion in there. He danced around that word and never said it. So Harris is a very effective messenger. She's a woman herself, a woman of color, and is very comfortable speaking with the younger generation, which is really who they're targeting here. So this is finally a place they've kind of found her that politically she is speaking to the right audiences.
I think that's fascinating. When you look at the portfolio that Joe Biden has given Kamala Harris, it's all the third rails. She's dealing with reproductive rights, to your point, actually standing in front of an abortion clinic today. On Friday, she's going to be meeting with 3 people who were pardoned over cannabis offenses, cannabis convictions. She's going to be speaking to the administration's apparent stand on this that a lot of folks have questioned. And while we're at it, she's got to solve the border. I realize that one might be a little bit older, and the president has leaned into the border a bit more because of the debate on Capitol Hill. But that's her portfolio, the 3 potentially most controversial issues they could find.
And 2 out of 3, abortion and cannabis, those are issues where the public's perception has become a lot more favorable just recently. So those are wins that she can potentially get, if not, in this term and next term. It's kind of like gay rights of, 10 years ago, where the public opinion shifted very quickly.
Yeah, okay. All of which were mentioned in the State of the Union address. And you do wonder if we're going to see a little bit more action on some of these, because you hear from young progressives, it's not just Israel that they're angry about, and they are. It's what they see as promises unkept on student loan forgiveness, realizing the administration ran into the courts on that, on legalizing marijuana. These were some of the social promises that were made when they first came into office.
And I think it's really important to not discount how important economic issues, particularly things like student debt, housing, that's another issue that Biden has really